I apologize for this lateness. The period of repose that I had looked forward to for this committee has been one of the less important victims of the current economic turmoil, and I've therefore had to cram more things into a shorter period of time than I'd hoped, and I apologize for keeping people waiting. This hearing has evolved to some extent in its orientation. There was originally concern about what was reported in the newspaper as two hedge funds saying that they were going to instruct their servicers not to take advantage of legislation that could reduce mortgages. We have since gotten letters from letters and statements from the funds, and I would ask you to put into the record a statement from Harvey Allen, who's president of Braddock Financial Corporation, and then also a letter from William Frey, who is the principal and CEO of Greenwich Financial Services. And Mr. Frey notes that he is not a hedge fund. Mr. Allen mentions that he is. But the letter from Mr. Allen, let me just read some excerpts in fairness before we get to the Braddock urges all servicers to fully acquaint themselves with the text and guiding principles of the Act, the Hope for Homeowners bill that we passed, and to actively undertake efforts to ensure that qualifying homeowners participate in this program and that their home loans are modified in a timely fashion pursuant to the letter and intent of the Act. So we believe this letter is entirely constructive and sets forward what we believe to be the appropriate policy. There is not an issue that is before us. We had never intended in the legislation for modifications to be imprudently granted to entities that could not, to individuals who couldn't sustain it. And whatever there was in terms of a misunderstanding in the communication, that's now been resolved, and we acknowledge that the Braddock Corporation is urging servicers to take full advantage in an appropriate way of the legislation on the books. Mr. Frey notes he a broker-dealer and said, for the record, I'd like to clarify that I do not manage a hedge fund as erroneously assumed in the letter to me dated October 24th. I hasten to add there was nothing wrong with hedge funds. We agree, obviously, with both cases. He also notes that all the credit support securities I own were originated before 2004 and are not based on subprime or Alt-A collateral. So he was inappropriately included in the article, and because he was inappropriately included in the article, he was then inappropriately the recipient of the letter. In one case, there was mistaken information on which we acted. In the second case, or the first case that I mentioned, the situation has been resolved, and the Braddock Fund is instructing its services to go forward. And now I will begin with the opening statement. The problem of servicers has become clearer and clearer. We have had some encouraging steps taken recently with regard to reducing foreclosures. And again, we stress, reducing foreclosures is one of three things, I believe, that has to happen if we are to get out of the economic mire in which we find ourselves. One is the reduction of foreclosures. Two, having the rescue plan that this Congress voted used efficiently, specifically to get the maximum amount of funds out into the economy that can be lent. And third, an economic recovery program that would include funding to the states and others to do job creation. This committee has jurisdiction over the first two, not over the third. As to foreclosures, the argument needs to be reemphasized that foreclosures damage the whole economy. Diminishing foreclosures is not entirely, maybe not for many people, even primarily a matter of compassion for those who will be foreclosed. As long as you have the foreclosure cascade, as long as you have mortgage-based securities decreasing in value so rapidly, you do not get out of the problem we are in. So diminishing foreclosures And clearly some people who took loans are beyond any assistance that could reasonably be extended. But diminishing foreclosures is an important part of helping us get out of this problem. Now, there have been assertions that the way to do that is, and there have been some plans floated, to have taxpayer money go in, buy up the loans, and then reduce the amount paid. I think it should be very clear, no matter what people have argued. There is, in my judgment, zero likelihood that federal taxpayer dollars will go to those who hold loans that never should have been made in the first place. People who have advocated a solution which involves federal assumption of the risks, 100% of loans that should not have been made, do not understand the mood of this country, do not understand what rules will apply. Similarly, I do not think you are going to see taxpayer funds, nor should you, to go to people to help them pay their mortgages. We have had some proposals. The head of the FDIC has been very constructive in this regard, Sheila Bair. We embodied it in our legislation. The role for the federal government that is appropriate, it seems to us, is this, in various forms. To induce those who hold the loans to recognize that they are holding loans that are not going to be repaid in full, to calculate that in many cases this would be a worse economic problem if they foreclosed, and to write down the terms of the loan, either by interest or principal or some combination, to a point where that borrower could repay. Doing so because it would be in their economic interest to get something rather than to go through foreclosure. The role of the federal government, the bill we passed, and as I understand it, what Sheila Bair is talking about, although like it's a little muffled by intra-administration concerns, is similar. It is to say to the lender, if you recognize that you are holding loans that cannot be realized and take a loss, we will then, through federal instruments, the FHA in our bill, in appropriate cases, guarantee the new level of loan. There'll be a refinancing to a lower level. What that says to the lender is you take your loss. The federal government is not going to make you whole for loans that shouldn't have been made in the first place. The inducement is that once you have recognized the loss, that will be the extent of your loss. You will then have some stability and some ability to tell people what you owe and don't owe. There will be some risk for the federal government in that because we will be guaranteeing these loans for people who had some problems before. In the bill we passed, that is accompanied by a requirement that any profit that is made on those loans be returned to the federal government in varying percentages for the first 5 years, and even more by the fact that the federal government then takes the house. This is not a free ride for that new borrower. There will be some losses, we were told by OMB, in a fairly small amount. I am hoping that Sheila Bair will be able to come up with a further approach. But then one other, we've also seen some encouraging efforts by the Bank of America and by JPMorgan Chase. And I would say I feel vindicated. I'm going to take a little extra time, and if there's no objection, but we'll allocate it equally. I will say I feel vindicated. When the Bank of America announced that it was buying Countrywide, a number of my friends were concerned that this would be a problem, that Bank of America was too big. And I was asked with some consternation by one person with whom I've worked on some issues, how I could justify supporting the Bank of America buying Countrywide. My answer is, at that point, I would have supported Syria buying Countrywide. The disaster that was inflicted on the country by Countrywide was deep-seated. I think Bank of America did a useful thing. Obviously, they're trying to make money, but I think the society will benefit. And so Bank of America, JPMorgan Chase, and now I'm told Citicorp as well, are taking constructive steps. We got an announcement yesterday that Fannie Mae and Freddie Mac will be doing more to improve the situation by reducing foreclosures, again, from the standpoint of helping us deal with the economic problem. But here is the problem that remains and will be on our agenda when we reconvene. So far, all of the advances in losses being recognized by those who imprudently either made or bought loans that shouldn't have been made, they have all been by the owners. And that's, of course, how we got into this. We have not seen servicers participating in any significant way. And I believe we now have a situation that requires legislation. We have been told by a number of people that the servicers do not have the legal authority, and we'd asked this question in general. We said to the servicers, and to the owners, is there enough legal authority to act on modifications, again, if it's in the economic interest of the holder of the loan? No one is here saying throw money over the side. But if you would be better off reducing the loan than foreclosing, do you have the authority to do that? We were told yes in general, but we are now being told no in particular. We have a serious obstacle, apparently. It's true with Fannie Mae and Freddie Mac and others. We are getting some progress where the loans are owned in a definable way. All the more reason why it's a good thing, to some extent, that Fannie and Freddie had a portfolio and hadn't securitized everything. But where we have servicers administering these securities, we apparently cannot get much done. And here's the problem. There should not be a public policy which allows important decisions that should be made in the economic interest of society to be unmakeable. You should not have a legal form in which the authority to make important decisions is so spread out and split up that no one can make them. I think what we've got is the equivalent of what all of us have seen from time to time, a very nice home in a neighborhood which is left by a deceased to several siblings who hate each other. And you get a situation where the quarrel among the siblings means that the house cannot be disposed of. And you come by what used to be a very nice home in a neighborhood that's now crumbling and in disrepair, and you say, what's that all about? And the answer is, well, it's got 4 sisters and brothers, and they can't agree. And the whole neighborhood suffers. I think, and the gentleman from California, Ms. Waters, had been very active in arguing this. I think this committee has to now act, and hopefully the whole Congress, on restructuring that servicing mechanism. Someone has got to have the authority to make a decision, and we face a situation now in which that isn't the case. So it's bifurcated. We're getting some progress where the legal authority to modify is clear. Took a while, but it's coming. We have not had that where there are services. Last point is this. When this Congress passed the Economic Stabilization Act and created the Troubled Assets Program, we explicitly put in that bill authority to the Secretary of the Treasury to buy whole loans or mortgage-backed securities to make us the lender, to make us the owner, so we could do these kind of reductions. Again, the distinction seems to be between, obviously, owners and servicers. To date, the Secretary hasn't used that authority. A large amount of the first $350 billion that was available is being used up for other purposes. 290 is now accounted for by advances to banks and the advance to AIG, the loan to AIG. That's a question now that we will have to address, and it will involve using the second 350. But I believe that we still have a need for that funding to be used to put the federal government in the position of being the owner so we can do the kind of sensible write-down of mortgage payments to avoid foreclosure that's in the interest of the economy as a whole. And we will be talking further about that as well, because we will have a hearing next week on the 18th on the administration of that program. And with that, I will now recognize the gentleman from Alabama.
I thank the chairman. Chairman, how much time are we going to have on both sides? Are we going to extend that time?
Yes. What's the maximum we can get?
10 and 10, then 10 on each side, 20 on each side.
20 and 20, because we have a fairly small panel. So
all right.
is that acceptable?
That's fine.
Yes, we'll do 20 on each side. We only have the one panel, and hopefully they don't have that much to do later. So
thank you.
thank you.
Thank you, Mr. Chairman. I yield myself 7 minutes. Mr. Chairman, first let me respond to the subject matter of this hearing. I have prepared a written statement which I have released, and that goes into some detail. I would like to respond to some of the things that the chairman has said. It is in everyone's best interest, as a general rule, to prevent foreclosures. Foreclosures have a negative impact on not only the family in that home, but also their neighbors, their property values, the community, and the local government. A number of foreclosures, as well as home ownership, are relatively good predictors of criminal activity and economic development. Having said that, I think we should be very careful in saying that we need to prevent all foreclosures. number one, if the homeowner is underwater, if the house is worth less than the mortgage, I don't believe it's in the best interest of the homeowner, in most cases, to continue to pay the note. In fact, what we're seeing all over the country, and most, I don't know whether it's most or a good number, a good percentage of foreclosures are homeowners that are underwater and they're walking away. And that's why they're walking away. Not so much as they can't pay it or they couldn't come up with the money. It's that they simply are not going to do that. And I don't see any practical way of preventing that. Second, when you have a bank and a borrower, the traditional arrangement, it's easy to work out deals, and it's normally in people's interest. Where we're running into a problem is with securitizations, and that's really the great majority of the mortgages that are in foreclosure or threatening foreclosures, where you have multiple parties. Now, that is, I think, what we're dealing with in this, as much as anything in this hearing. Obviously you're talking about hedge funds, so you're talking about securitized mortgages. In those cases, I am all for encouraging the parties to work together, if they're willing. Now, often they're not willing. And in those cases, I am very hesitant to do two things. One, I'm very hesitant to try to force the parties to an agreement. One reason, and let's say a willing buyer but an unwilling lender or hedge fund or whoever is holding securitized mortgage, it affects future funding of future mortgages. I mean, if you're going to start interfering with contracts, you may get away with it with these, but how about mortgages in the future? Are people going to be willing to buy securitized mortgages? And the answer is no, they're not. Because if they think that the Congress or the government can come in there and change that contract, they're just not going to be willing to put their money at risk. So we have to be very careful in that case. The only other thing I would say is that I'm also skeptical of any proposal which requires the borrower to be 90 or 120 days late on their payments. That, to me, is going to almost encourages people who may be current and struggling they don't qualify unless they're 90 days late or, And I actually had a constituent that called us and said, we're not going to qualify for this program because we're current. What should we do? Should we miss 3 payments? Having said that, let me say that I commend the chairman for holding this hearing. Now, let me change the subject to what we're dealing with overall, and that's government intervention into the private sector through either we call it intervention, a bailout, a rescue plan, et cetera, et cetera. We have all, as members, had 3 weeks to go home. And if you're like me, I basically will boil down the questions my constituents ask me to 2 questions. The first question is basically, I can boil it down to, how do you justify giving my money to somebody else as a taxpayer? How do you justify that? How do you, in a case of mortgages, hey, I went out, I negotiated a good price for a house, I bought it, I put 20% down, I put 10% down. I was very careful on the terms, I got a good interest rate, I'm paying my mortgage, I'm paying it on time. I don't think it's fair that you're going to take my taxpayers and subsidize or change a loan to someone else that wasn't as careful as I was or wasn't as responsible. Not that my constituents don't think they're necessarily bad people. They just don't want their money going to them. Now, we're now talking about a bailout to the automobile companies. I know the questions we're going to have because of questions we had with financial services. I have automobile plants in my district. Those automobile plants pay $25 to $35 per employee per hour. I'm sure that I'm going to be asked, Congressman, I work at Honda or I work at Mercedes. I get $40 an hour. Why are you going to take my tax dollars and pay it to a company that's paying their employees $75 an hour? And these are questions we need to anticipate and need to be prepared to answer. Even, I think, people that are going to be more hostile are that sawmill worker in my district who's making $15 an hour. And he's working hard every day, and he gets very dirty every day. And it's a risky, hot job. Or it's very cold. It's usually very cold or very hot. And he's making $15 an hour. And we're taking his money, and we're paying it to a company that's paying $75 an hour. We're going to get those questions. We need to be prepared to answer them. How do I know we're going to get those questions? Because with the financial services companies, the Wall Street companies, we've already got those questions. If you didn't get those questions, you're not listening to your constituents. They're already beginning to ask. My constituents usually get about a $250 bonus at Christmas. They're already asking me, Congressman, did you take my money and give it to a company that is paying some of their employees $250,000 at Christmas or year-end bonus or incentive or whatever you want to call it, and I get $250? It's a fairness issue, and it's something that we are going to have to answer. The second question is very simple, is where does this stop? How do we get out of this mess? When are we going to quit? When are we going to end it? Well, we started with financial services. We went from banks to insurance companies, and I will tell you this, I for one realized, and I think we all did, we could not let our financial structure of this country, our financial infrastructure, our banking system, we could not let it collapse. That was something that we could not allow. But now we're talking about manufacturing companies, automobiles. You start there. Does it end there? It didn't with financial services. We kept expanding that. And does it end with manufacturing? What about retail? What about Circuit City? I've read now that a lot of Circuit City employees are even more angry this week than they were last week, that they're losing their jobs, and they're seeing what's going on Capitol Hill, where we've intervened or bailed out on behalf of a lot of financial services companies and manufacturing companies. And I'm afraid if we don't answer the question very soon, when does this stop, that it's going to stop when we run out of money, when we're unable to print more money, when foreign countries are unable to lend to us at a reasonable interest rate. And quite frankly, we need to stop before then. If we don't, I think the American people will simply rise up and stop us. And I, for one, hope that we're rational and reasonable enough to, going forward, be very, very careful. I want to conclude on a positive note. We did something I think very good. In the last intervention, it was originally proposed that we buy $750 billion of the very worst assets in the financial system. And the proposal was that we actually buy those assets and that we manage them. Now, we would have had to hire thousands of people to do that, and that we service them. Thank goodness, I believe we've almost dodged that bullet. Instead, what we did was a much more reasonable and rational approach, something that protects the taxpayers to a greater extent, not to a total extent. And that was we took preferred shares. We did the same thing Warren Buffett did. We made a deal. And we don't have to manage those assets. We don't have to set a price. We don't have to buy them. We don't have to sell them. We simply took preferred shares. And that was a much better approach. We're still talking about buying some of these, we call them worthless assets, call them impaired assets. And that's not going to be as good a deal. But so far, we've made a terrible situation better. But let's have an exit strategy. Let's now agree that it has to stop, and it has to stop soon. Thank you, Mr. Chairman.
The gentleman from Pennsylvania is recognized for 4 minutes.
Good morning, Mr. Chairman. While the theory behind mortgage loan modifications remains sound, the practice has fallen short of expectations that many of us have. Keeping Americans in their homes should be a priority. Unfortunately, this view does not appear to be shared by all. Today, we will hear from several parties in the private sector to better understand the ever-widening gap between what ought to happen and what is happening. We will also discuss some of the proactive steps taken to date to address this important issue. This issue is not a partisan one. Back in March, Mr. Counsel and I introduced the Emergency Mortgage Loan Modification Act of 2008, H.R. 5579. The bill aimed to clarify the responsibilities of and provide a safe harbor from legal liability for mortgage servicers who help troubled borrowers remain in their homes by engaging in loan modifications and workouts according to specific criteria. While pieces of that legislation did become law through the enactment of the larger housing package, the safe harbor provision fell by the wayside. At the hearing we held on H.R. 5579, Mr. Counsel stated, quote, "I believe Congress can take specific steps to ensure loan servicers work with homeowners to keep mortgages solvent wherever practical," unquote. I shared that sentiment then, and I believe it today. Congress last spoke to the issue when passing the Emergency Economic Stabilization Act, which provided guidance and authority for the Treasury Department to increase the number of loan modifications. Despite our actions, certain industry players, and in fairness, the current administration and government housing agencies simply have not pursued modifications with the urgency our nation's financial crisis demands. This reality must change quickly. As homeowners continue to find themselves underwater, we must all work to keep them afloat. More and more foreclosures have led to ever-declining home values, and spiking foreclosure rates have also decimated some communities. Pointing fingers about which borrowers irresponsibly took out loans they could not afford or which lenders recklessly doled out money to unqualified borrowers do absolutely nothing to solve the problem. Instead of placing blame, we must work together toward a solution. In this regard, I am pleased that entities like the Bank of America and JPMorgan Chase have stepped forward with their own initiatives for expediting mortgage modifications. Our lenders and servicers can learn from these actions and model their mortgage modification programs on these efforts. In sum, our witnesses will help us all understand why loan modifications have not already increased and what can be done to ensure that a greater number of loan modifications occur in the days ahead. I look forward to their testimony and thank them for being here.
Gentleman from Texas is recognized for 4 minutes.
Thank you, Mr. Chairman. First of all, I want to associate myself with the ranking member's remarks on a number of fronts, but certainly on the direction that we're headed in this country as far as this major intervention into our markets by the federal government. Interesting, before the first vote, over the weekend before that, I was sitting in my office and I decided to take some calls from people in the district. We've never had as many calls on one specific issues we did on that one. And interestingly enough, on 5 o'clock on a Sunday afternoon, a young man that attends Texas Tech University called me from his dorm room. And he and 3 or 4 of his buddies were sitting around in the dorm watching the news. And they said, "Congressman, we're not quite sure we understand all the things that are going on in these markets. but we do understand that you're about to mortgage our future even more than it's already been mortgaged. And in fact, we did do that. We had to increase the debt ceiling to $11.3 trillion. I think what Ranking Member Backus was saying is that members of Congress all have these voting cards. Right now we're using them as credit cards. And what we're doing is we're subsidizing the living and the lifestyle that we have today, and we're asking the next generation to pay that back. I'm not sure that's good for them. I'm not sure that's good for us. In relation to this hearing today, I've had a number of conversations with people that are involved in mortgage workouts and mortgage servicing over the last few months. And one of the first things that they tell me is foreclosure is the last resort for both the borrower and the lender, because what happens at that particular point in time is somebody loses their house and the lender loses a lot of money. And what I've also heard from them is that aggressively, many mortgage servicers and banks and institutions are working aggressively with borrowers that will work with them. Interestingly, the statistic that I'm hearing is that if you take, say, 10 people that are behind on their mortgage, that you send a letter and the first 4 get current. The next 4 get current after a couple of letters have been sent. And the last 2, one of those people will most likely not return a phone call, answer a letter, or work with the lender in any way, and leaving the lender very little opportunities. But one of the things that most of those folks told me, and I'm sure we're going to hear from the witnesses today, that if somebody will enter into a dialogue with the lender, there will be some effort to try to keep those people in the home, because, again, the lender does not want that property back, particularly in this real estate environment. I think the second point is, and I think the ranking member was alluding to that, is overall our mortgage finance structure in this country has worked relatively well for a number of years. Yes, we had some people that abused it, and for that, the market has been punished. But one of the things I think we have to be very careful moving forward is that looking at the short term, what are we doing to the long term? The best thing we can do for America and people that own homes today is to get the housing market back functioning again. And the way you get the housing market back functioning again is you get the housing finance market back functioning again. We have to be very careful that we do not do things here that impact the ability of the mortgage finance market to get back up and running again. For example, creating some doubt in the minds of people that are insuring mortgages, the PMI companies, that in somehow the contractual relationship causes them to lose more money than the risk that they realize they're taking. Also, making sure that we get securitization back up and going again. Securitization has become a nasty word, but quite honestly, it has provided an opportunity for us to provide a lot of housing finance in the future. And also, we don't want to encourage borrower behavior that's not appropriate. And like the ranking member, constituents calling into, so the plan is we get 90 days behind and then we get a piece of the pie. That's an entitlement mentality that's permeating our country today, and I think we have to be very careful as we move in that direction. So while I think these discussions will be productive, I think we should be very careful in moving in a direction where we're going to mandate that mortgage companies do have certain behavior. I think we want to encourage good behavior. Quite honestly, I believe that behavior is probably already taking place in the market today. Thank you.
Gentleman from New York is recognized for 2 minutes.
Thank you, Mr. Chairman, for holding this important hearing. In my view, this Congress has been pushing and dragging a reluctant administration to help homeowners in the same way and on the same scale that the Treasury rushed to help Wall Street. Yesterday, the administration announced that Fannie and Freddie would help a couple of 100,000 homeowners restructure their loans using a systemic loan modification that was developed by the FDIC at IndyMac. Systemic loan modification is a good step in the right direction, but this program is only a timid and tiny one. We need to be thinking in an order of a magnitude that is much bigger, not hundreds of thousands, but millions. Some economists estimate that 2 to 5 million Americans may lose their homes. Treasury said that this new protocol will be a standard for the industry to quickly move homeowners into long-term sustainable mortgages. And I hope to hear of their efforts today. I do want to say that I am encouraged by the steps that were reported recently from JPMorgan Chase, Bank of America, and Citibank on efforts that they are doing to help people stay in their homes. All economists say that we will not solve this problem until we stabilize home prices, housing in America. It is very vital for stabilizing our economy. I look forward to hearing your testimony today on ways we can expand the program, not to hundreds of thousands, but to literally millions of Americans. Thank you.
Who's next for you? Who? How much time? Gentlewoman from Illinois is recognized for 4 minutes.
Thank you, Mr. Chairman. I thank you for holding today's hearing, and I'll offer a few quick thoughts so that we can proceed. First, I'm pleased that the private sector continues to work independently and with government entities to keep qualified homeowners in their homes. And I'm particularly pleased that these initiatives don't involve taxpayer dollars. However, I do remain concerned about the issue of fairness, which it comes to when it comes to homeowners who may have live beyond their means or not saved for a rainy day, who are getting a deal versus prudent homeowners, and that's most homeowners who are making their mortgage payments and not getting a deal on a mortgage modification. That aside, I think it's become increasingly clear that with a little lender and servicer flexibility as well as one-on-one counseling, many American homeowners in trouble can make their mortgage payments, can live within their means, and stay in their homes. To many of my constituents facing mortgages and other financial troubles, counselors are a critical lifeline, and I'd like today's witnesses to comment and offer ideas on how we can increase troubled borrowers' access to HUD-certified counselors and increase financial literacy. Second, FDIC Chairwoman Sheila Bair offered an idea to use the $50 billion of TARP money to guarantee mortgages, and I'd like today's witnesses to comment on that. In addition, I would be interested in any reaction to Chairwoman Bair's statement on, and I quote, that there are questions that remain about implementation, quote, of the new GSE mortgage modification plan, which was announced yesterday. And finally, I think it's no secret that industry participants represented today by ASF and in part by MFA are purportedly stuck between a rock and a hard place. We'll hear testimony that clearly indicates the willingness of the members of ASF and FAA to do whatever is possible to keep homeowners in their homes. And the problem that has been mentioned is that some industry participants with this willingness also hold contractual obligations to investors, which include our seniors with retirement funds and workers with pensions, and so that they will be able to maximize the value of troubled mortgage loans. Well, as the saying goes, where there's a will, there's a way, and I'd like to hear from today's witnesses exactly and specifically about how quickly the industry can collaborate, put together new guidelines to establish a floor for net present value and ultimately improve the process of mortgage modifications. It's important that sooner rather than later the right balance is struck so that, number one, qualified homeowners can stay in their homes. Two, investors clearly understand and accept a mortgage modification process. And that three, servicers can obligate sufficient resources to modify the mortgages. And four, that fraudulent actors are exposed and prosecuted. And five, underwriting standards are strengthened so that a similar boom and bust cycle is not repeated. I look forward to hearing from today's witnesses, and thank you, Chairman Frank, and I yield back.
The gentleman from New York, Mr. Meeks, for 2 minutes.
Thank you, Mr. Chairman, and I just want to thank you for a great job that you're doing in conducting this hearing this morning and just dealing with this whole crisis that we have. We're very proud of you and what you've been doing. I'll be real brief. I mean, we all know about the economic crisis that we're going through. And the one way that when we talked about TARP and the $700 billion that we were often talking about was that this is where Wall Street meets Main Street, where Wall Street meets Main Street. And the way that we can show our constituents that Wall Street is meeting Main Street and how we're not only just trying to fix the situation in regards to our financial institutions is to show that we're also trying to keep Americans in their homes. And reworking these mortgages, et cetera, becomes extremely important in doing that. Because absent that, then of course we have this problem. And I could go on with a litany of statistics in my district, for example, in Queens, which is leading the city of New York in foreclosure rates, in the price of homes are going down, in how long it takes to sell a house now, and on and on and on. But the key is trying to make sure that we keep people in their homes. I've assembled in my office now on a weekly basis, counselors, financial advisors, and attorneys. Every week on a Wednesday, from 1 to 5, I have these counselors in my office, and we set up appointments, and they've been jam-packed, and we're packed up now for the next, I think it's 6 weeks with people. And I'll ask some questions when we get to the question period, but I just want to say that the key to this and getting out of this crisis that we're in is keeping people in their homes. And I want to compliment those individuals in the programs that I recently heard in regards to Citi and I think Chase and a few others, and we want to get into that, as we ask questions. But and that's why hearing from you and what your testimony and how we can make sure this is working is extremely important. So I thank you for being here today, and I await your testimony.
Gentleman from Ohio, Mr. Latourette, for 3 minutes.
Thank you, Mr. Chairman, and thank you for having this hearing, and I especially look forward to the next hearing that you're going to have on the 18th, and thanks also for chatting with me over the break about National City Bank in Cleveland. All I can say is what a mess this is. And Mr. Chairman, I have the highest respect for you, and I think my plea this morning is after these hearings are over that you use all of the wisdom that you have to help us think outside of the box. And the reason that I say that, if you go to the bill that we passed in July, which Chairman Frank really did yeoman-like work on, and I fully supported that piece of legislation. I've been told that only 42 mortgages have been submitted to date for modification, and none have been granted because it takes 60 days, and that the regulators are saying that by next fall it'll only be 20,000, far short of the 400,000 that we envisioned when we passed that legislation. I'd ask unanimous consent to include into the record an article written by, I never read this fellow before, but he's really on the money on this, Jonas Serra from the New York Times of November the 11th.
Without objection.
And Mr. Nacera makes the argument that, which is the subject of that hearing, and that is everybody sees the wisdom of mortgage modifications except nobody talked to Wall Street. And he makes the point that I think it's good that Fannie and Freddie have jumped up and they're going to come up to 38% of their gross income modifications. Citigroup is good. JPMorgan is good. But if we don't do something on the liability that the fiduciaries have, we're not going to be able to refinance or modify anything. And so I would hope that the witnesses today, the title of Mr. Nacera's article yesterday is, "Can anyone solve the securitization problem?" So I would hope that maybe the witnesses chat about that with us, and can we solve the securitization problem to actually have modification of mortgages? And then lastly, the hearing next week is going to talk about TARP, but I have to tell you, Mr. Chairman, that we got to get to the bottom of this and think outside the box, because this TARP business, again, Mr. Nacera and others have pointed to the fact that rather than buying troubled assets, rather than buying preferred stock, now banks are hoarding the money. Maybe they don't want to lend it. And in the case of PNC and National City Bank, they've used TARP money for one bank to buy another bank. And being from Cleveland, I got to tell you, a Pittsburgh bank buying a Cleveland bank is a bad, bad, bad thing. And that wasn't what I thought the bill was supposed to be all about. But that's where we're headed. So again, I appreciate your leadership, Chairman Frank and Ranking Member Baucus, but I really urge us to get this right and get this done so that we can move this forward and keep people in their house.
The gentleman from Texas is recognized for 2 minutes. Mr. Green.
Thank you, Mr. Chairman and Ranking Member. I find myself in accord with the previous speaker. The situation seems such that the home buyers are indicating that they'd like to avoid foreclosure. The lenders and servicers are indicating that foreclosure avoidance is a good thing. In fact, information that I have indicates that it costs about $40,000 to $50,000 in attorney's fees and fees for property management when a foreclosure takes place, and that's per unit. It seems that we're all in agreement that foreclosure is not a good thing and that it should be avoided, but it's not happening. And the question becomes, how do we connect the disconnect between the servicer and the borrower such that the foreclosure avoidance can actually take place? I have not to date heard of any legislation that would be mandatory, requiring write-downs of principal, requiring interest rates to be reduced. I have just not heard of such legislation. It may exist, but it has not been presented in a forum such that it can be debated and discussed, especially here at this committee level. And my fear is that if we continue to fight that which does not exist, it will make it difficult to deal with that which does exist, which is the necessity to connect this disconnect and try to avoid foreclosure without a mandatory requirement of a write-down or a reduction of interest rates. I am absolutely convinced that this is a solvable problem. It is one that requires careful thought, but it is something that can be resolved. And I thank you for the time, Mr. Chairman. I yield back.
Gentleman from Georgia, regularly 3 minutes.
Thank you, Mr. Chairman. I want to thank the Chairman for holding this hearing as well, and I had to step out for a moment. I don't know that anybody's mentioned what happened last Tuesday, but it seems like it would be inappropriate not to at least congratulate the Chairman and his party on the election last Tuesday, and just say that I think that the American people are now ready for us to move on this issue and others and work together and solve these challenges, and I, for one, look forward to that as well. We are all very concerned with the critical situation of home ownership and foreclosures. I think it's imperative, though, that we also recognize that over 90% of Americans either own their home or are current on their current payment schedule. There is a major problem, without a doubt, and it needs to be addressed. Of those that are challenged, it's my understanding, as has been mentioned, that over 50% of them, the borrower hasn't contacted the lender to determine how they might be able to work on voluntarily changing the parameters of the agreement and see if they couldn't remain in their home. So I'm hopeful that we concentrate on those voluntary activities, as some on the other side have mentioned. I want to commend, there's so much that has been done and can be done. I want to commend Mr. Meeks for what he's doing in his community. Obviously, there's a lot of folks that are working to try to get borrowers and lenders together to talk when there are concerns that are being, that are occurring. Some have said that we should not have, however, a public policy where decisions that are in the best interest of society are not makeable. I would suggest that the concern about that statement is that the best interest of society is movable or is changeable or is may be different depending on where one sits. The squabbling siblings that were mentioned before and not able to find out what the disposition of the home ought to be, unless it's a condemnation situation, and there are laws that are in place to help in that area. But unless it's a condemnation situation, there are other laws in the courts of law to determine what ought to occur. To have the notion or the sense that it's the federal government's responsibility to step in that situation and be the owner of the home, I think is a step that frankly the American people are not interested in taking. I would ask the witnesses specifically to talk about the moral hazard argument or the moral hazard situation that we find ourselves in. I want to thank the chairman for correcting the record regarding Greenwich Financial, and I look forward to the testimony.
The gentleman from Massachusetts is recognized for 2 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I want to make it clear as to what my understanding of why this hearing is here today is because I believe it's the best way for us to get our message out and also to hear from some people from the industry that some of us think that the industry hasn't gotten the message yet, that we want individual homeowners helped. Now, I don't think the people that are here today didn't get that message, but I think some people in the financial services industry didn't get it. I don't think anybody believes that every single homeowner can or should be helped. That's not the point. But something more than 42, maybe a few 100,000, pick a number, but something. And there are many of us who feel that the industry hasn't gotten the message. And this is one way to do it, and also for us to find out if there are technical ways for us to assist the industry in implementing the message. But I also want to make it very clear that I hope, and I'm looking forward, I'm sure there will be other hearings. I'm actually, frankly, getting a little tired of having the chairman have to get on TV and tell the industry we don't want them to use money for mergers. We don't want them to use taxpayer monies for vacations. We don't want them to use taxpayer money for outrageous bonuses. Now, I'm not saying they can't do those things, but use their own money. And if they don't get it, I think we're going to have some further discussions with both the Treasury Department, and I actually take last Tuesday's result as a comment by the American people that they want a more activist government to be involved in these things. We don't want to tell anyone what they have to do. That's not the desire. That may be necessary. Now, my hope is between now and then, the industry gets the message that we want more individuals helped, that we don't want taxpayer money being used for these ludicrous purposes. We want it used for one purpose and one purpose only, which is to get the American economy back on its feet and moving in the right direction. Again, I don't mean to address my remarks to this particular panel. I think, from what I know, you're all on the right page and trying to get in the same direction. At the same time, it is one of the few opportunities we get to allow the American people and, more importantly, the financial services industry to hear us and hear us as clearly as can. With that, thank you, Mr. Chairman, for your opportunity.
In the last allocation of time, 2 minutes, the gentleman from Illinois, Mr. Foster.
Let's say I'm most concerned in this thing is that we somehow don't get into this mess again. That one of the things I'd be very interested in hearing about is whether or not there's well understood language that could be incorporated into future securitization contracts and so on that would make them easier to unwind in times of financial stress, so that we really have an understanding that if, as the securitization industry reemerges from the current crisis, that when this happens again, that everyone understands the rules on how we get out of this fast and simply. And I'd be very interested in hearing your comments on that. That's about it.
We will now proceed with the panel, and we will begin with Mr. Benjamin Allensworth, who is the Senior Legal Counsel of the Managed Funds Association.
Chairman Frank, Ranking Member Backus, members of the committee, my name is Benjamin Allensworth. I am Senior Legal Counsel for Managed Funds Association. MFA represents the majority of the world's largest hedge funds and is a primary advocate for sound business practices and industry growth. MFA appreciates the opportunity to testify today about efforts by private sector participants to work with federal, state, and local officials in seeking to mitigate the current wave of foreclosures and defaults. Our fundamental belief is that effective mortgage modifications are preferable to foreclosures whenever possible. As we have all learned over the past 12 to 18 months, our nation's housing market is critical to the social and financial well-being of families and communities throughout our country and is central to the health and vitality of our capital markets and our economy. The wave of foreclosures has placed downward pressure on home prices, eroded home equity, and shattered confidence, which in turn has led to a freezing up of the mortgage-backed securities market, a major source of liquidity and credit to our capital markets. That cascading effect has led to the tightening in broader credit markets as market participants have been forced to satisfy redemption requests of investors and hold more capital. To stem the effects of this crisis, bold, proactive steps need to be taken. MFA and our members are committed to working with policymakers on effective remedies to address these serious economic challenges. Over the past few months, Congress has enacted a number of measures in response to the ongoing crisis in our mortgage and credit markets, specifically the Emergency Economic Stabilization Act and the Housing and Economic Recovery Act. The central element of HERA is Hope for Homeowners, a program intended to help those at risk of default and foreclosure move into more affordable loans insured by the FHA. MFA believes that with additional time and continued collaboration, Hope for Homeowners can serve as a valuable tool to mitigate foreclosure and help inject much needed liquidity back into the mortgage and credit markets. While MFA does not have a formal association policy regarding the terms and conditions for modifying MBS contracts, our association and our members strongly support effective mortgage modifications over foreclosure whenever possible. Loss mitigation is a challenge for all MBS market participants and investors. That includes hedge funds, which do invest in mortgage-backed securities, though comprise a relatively small part of the MBS market as compared to other investors. There are a number of legal, fiduciary, and practical issues that must be taken into account when considering mortgage modifications. Mortgage servicers and institutional investors have fiduciary duties to their investors and clients respectively. Fiduciaries must weigh the effect of mortgage modifications on the earnings of their investors, which include pension funds and retail mutual funds, among others. Other factors, including the likelihood of a subsequent default, are also considered when making these important determinations. As market participants consider these obligations in the context of loan modifications, one of the primary determinations is whether the net present value of a modified loan is greater than the NPV of a foreclosure. In preparation for this hearing, MFA has sought out the views of our members and other stakeholders to help us better understand the impediments to more robust loan modification efforts. Among the concerns most commonly cited were the process, technology, and accuracy in calculating NPV for modifications to groups of mortgages, as opposed to the calculation of NPV when done on a mortgage-by-mortgage basis. The higher rates of subsequent default and the impact of that likelihood in the NPV calculation for non-HERA modified loans. The capacity of servicers, some of whom may be overwhelmed by having to make NPV determinations for so many troubled mortgages. And also constraints on the part of some servicers who may be willing but unable to do loan modifications under HERA because they lack the ability to originate FHA-insured mortgages. While each of these challenges has the potential to undermine loan modification efforts, none are so daunting that they should deter us from our shared interest in keeping more families in their homes and restoring stability and confidence to our mortgage and credit markets. In this regard, we believe there are some important measures that could be considered to help accomplish this important objective. These include developing a set of standardized protocols that would enable servicers to more efficiently calculate NPV. Yesterday's announcement by the administration that as part of the Hope Now initiative, it will implement protocols to help streamline the loan modification process is a hopeful sign, though more is needed. Encouraging more owner-servicers to do loan modifications and finding ways to have mortgage-backed securities held and administered by a single entity rather than a variety of entities with competing interests, which should provide for a more efficient loan modification process. Last, examining the implications of higher subsequent default rates for non-HERA modified loans. We believe it is in the best social and economic interest to find ways to reduce the risk of future defaults on mortgage modifications of all types. Mr. Chairman, as I stated at the outset, MFA and our members appreciate the social and economic importance of preventing mortgage foreclosures, and we are committed to working collaboratively with policymakers and other market participants on preserving the American dream of homeownership for millions of at-risk families. Thank you for the opportunity to testify before this committee. I would be happy to answer any questions you may have.
Thank you very much. And now we'll hear from Ms. Molly Sheehan, Senior Vice President, Home Lending Division, JPMorgan Chase.
Chairman Frank, Ranking Member Bacchus, and members of the Financial Services Committee, we appreciate the opportunity to appear before you today on this most important topic of helping homeowners. We recognize that no one benefits in a foreclosure. My name is Molly Sheehan, and I work for the Home Lending Division of JPMorgan Chase as a Senior Housing Policy Advisor. Chase is one of the largest residential mortgage servicers in the United States, serving over 10.5 million customers over the platforms of Chase and, more recently, WAMU and the EMC unit formerly affiliated with Bear Stearns. With mortgage and home equity loans of approximately $1.5 trillion in every state of the country, we are proud to be part of one of this country's preeminent financial institutions with a heritage of over 200 years. Chase services about $332 billion in mortgages and home equity loans it originated and owns. It also services or subservices an additional $1.1 trillion of first lien mortgage loans for investors. As you know, we announced 2 weeks ago several significant enhancements to our foreclosure prevention and loan modification efforts. We would like to share those with you today. While we have helped many families already, we feel it's our responsibility to provide additional help to homeowners during these challenging times. We will work with families who want to save their homes but are struggling to make their payments. That's why we announced on October 31st that we are undertaking multiple new initiatives designed to keep more families in their homes. We will open regional counseling centers, hire additional loan counselors, introduce new financing alternatives, proactively reach out to borrowers to offer pre-qualified modifications, and commence a new process to independently review each loan before it moves into the foreclosure process. We expect to implement these changes within the next 90 days. While implementing these enhancements, we will stop additional portfolio loans from entering the foreclosure process. This will give potentially eligible homeowners in owner-occupied properties an opportunity to take advantage of the new enhancements. Chase has worked diligently and will continue to work diligently with investors to get their approval to bring these enhancements to loans that we service on behalf of others, so our efforts can have the broadest possible impact. The enhanced program is expected to help an additional 400,000 families with $70 billion in loans in the next 2 years. Since early 2007, Chase, WAMU, and EMC have helped about 250,000 families avoid foreclosure, primarily by modifying their loans and payments. So, more specifically, what we will do, systematically review our entire portfolio to determine proactively which homeowners are most likely to require help, and try to provide it before they are unable to make payments. Proactively reach out to homeowners to offer pre-qualified modifications, such as interest rate reductions, term extensions, and principal forbearance where needed. The pre-qualified offers will streamline the modification process and help homeowners understand that Chase is offering a specific option to make their monthly payments more affordable. We will establish 24 new regional counseling centers across the country to help provide face-to-face help in areas with high delinquency and foreclosure rates, building on the success of the 1- and 2-day Hope Now Reach Out days, and we will partner with community counselors to reach more borrowers. We intend to add 300 more loan counselors, bringing the total to more than 2,500, so that delinquent homeowners can work with the same counselor throughout the process, improving follow-through and success rates. We will expand the range of financing alternatives offered to modified pay option ARMs, which we inherited when we acquired the mortgage portfolios of WAMU and the EMC unit, to an affordable monthly payment including 30-year fixed-rate loans, interest rate reductions, principal deferral, and interest-only payments. All of these alternatives will eliminate negative amortization. We will also offer a substantial discount on or donate 500 homes to community groups or through nonprofit or governmental programs designed to stabilize communities to deal with the growing inventory of REO. These enhancements reflect Chase's commitment to continue to seek additional ways to help homeowners. And thank you for your attention, and I'll be happy to answer any questions you may have.
Thank you, Ms. Sheehan. And now we'll hear from Mr. Gross, Managing Director of the Loan Administration Loss Mitigation at the Bank of America.
Good morning, Mr. Chairman and committee members. Thank you for the opportunity to appear again to update you on our efforts to help families stay in their homes. Bank of America fully appreciates its role in helping borrowers through these difficult economic times. We are committed to being a responsible lender and servicer and facilitating home ownership and retention. First, I wanted to provide you a brief update on our mortgage business. We are open for business across America. From July through September, we funded more than $50 billion in home mortgage loans, financing over 250,000 homes. We are also working hard to help customers who may be in trouble. We've developed important programs that are projected to provide relief for over $100 billion in loans, enough over 3 years to help keep up to 630,000 borrowers in their homes. Included in the $100 billion is Bank of America's ambitious new homeownership retention program announced on October 6, potentially impacting and assisting up to 400,000 homeowners. It is designed to achieve affordable and sustainable mortgage payments for customers who finance their homes with subprime or pay option adjustable rate mortgages serviced by Countrywide and originated by Countrywide prior to December 31st, 2007. Our 5,600 home retention professionals will be equipped to serve eligible borrowers with these new programs by December 1st of this year. Please know that the foreclosure process will not be initiated or advanced for a customer likely to qualify until we have made a decision on the customer's eligibility. The centerpiece of the program is a proactive loan modification process to provide relief to eligible customers who are seriously delinquent or are likely to become seriously delinquent as a result of loan features such as rate resets or payment recasts. Various options will be considered for eligible customers to ensure modifications are affordable and sustainable. First-year payments of principal, interest, taxes, and insurance will be targeted to equate to 34% of the borrower's gross monthly income. Modified loans feature limited step rate interest rate adjustments to ensure annual principal and interest payment increases at levels with minimal risk of payment shock. The program's foreclosure alternatives provide a win for homeowners and investors and are intended to assist in the effort to stabilize the country's deteriorating housing market. Loan modifications will be made in accordance with servicing contracts, and where servicing contracts limit or prohibit modification, Countrywide will seek consent from investors and other associated third parties. Finally, I would like to highlight a couple of continuing impediments to loan modifications for the committee's consideration. Bank of America today services approximately 15 million mortgage loans. Some of these loans are held for investment in our own portfolio, but others are serviced on behalf of investors, including GSEs, government entities, and private investors. Our servicing is governed by the underlying pool and servicing contracts and related rules of these investors. For loans that are held for investment, we have broad flexibility to modify the loans. For other categories, however, investor rules and underlying servicing contracts with respect to modifications are not uniform and may prevent us from doing modifications that would benefit both borrowers and investors. Under some arrangements, for example, servicers have express or implied authority to make loan modifications, while under other arrangements, loan modifications are expressly disallowed. Even within categories of investors, such as the GSEs, there is a significant variation in the rules that apply. Servicers are frequently unable to effect loan modifications because of contractual prohibitions. Another challenge is the lack of uniformity in approaches to loan modifications. Servicers increasingly are accelerating their and our loan modification practices. Examples include voluntary loan modification programs like ours, as well as government programs like the FDIC and DMAC program. Servicers are employing usual and customary loan modification techniques, such as interest rate and principal reductions and term extensions, and they are developing underwriting and other guidelines to determine when and what type of loan modification is appropriate that benefits both homeowners and investors. Bank of America supports government and industry efforts to develop greater consensus regarding these elements of loan modification programs. Yesterday's announcement by the Treasury Department, Federal Housing Finance Agency, and GSEs to adopt systematic loan modification programs will help drive uniformity amongst these entities in the approach to loan modifications. We believe industry organizations, including those appearing before you today, also should play a role by issuing additional standards for loan modifications that will encourage servicers to do more. There are certainly other challenges, and we would be glad to discuss those with the committee subsequent to the hearing. Thank you again for this opportunity to discuss Bank of America's efforts to keep our customers in their homes. Today's market conditions demand expedient, affordable loan modifications that help customers while protecting returns to investors. This is a critical, important undertaking that must be done right if we as an industry are going to preserve the flow of capital of mortgage credit to support housing and at the same time protect communities and neighborhoods from avoidable foreclosures. Thank you for this opportunity to appear.
And next, Ms. Thomas Deutsch, who's Deputy Executive Director of the American Securitization Forum.
Chairman Frank, Ranking Member, and distinguished members of the House Financial Services Committee, my name is Tom Deutsch, and I am the Deputy Executive Director of the American Securitization Forum. I very much appreciate the opportunity to testify before this committee again on behalf of the more than 330 member institutions of the ASF, including mortgage lenders, servicers, and all institutional investors, regarding loan modifications and how our industry and the federal government can work together to prevent avoidable foreclosures. I testify here today with one simple overarching message. Industry participants have been and will continue to deploy aggressive and streamlined efforts to prevent as many avoidable foreclosures as possible. But macroeconomic forces bearing down on an already troubled housing market are simply too strong for private sector loan modifications alone to counteract the nationwide increase in mortgage defaults and foreclosures. In my testimony here today, I look to outline a number of ways that the industry and the government can work together to target relief to troubled homeowners while simultaneously helping to restore credit to mortgage borrowers. Economic and housing market conditions have clearly deteriorated over the last 18 months, with that deterioration intensifying as of late. Job losses, declining home values, and borrowers' consumer debt have all put extreme strain on homeowners' abilities to pay their mortgage debts. Given these unprecedented challenges, servicers have responded with unprecedented efforts, as no securitization market constituency, lenders, servicers, or institutional investors benefits from loan defaults or foreclosures. As a result, the number of loan modifications, for example, has increased by over 6 times the rate at which they were being provided to borrowers at this time last year. One driving force behind this exponential increase was the streamlined framework the ASF put together and developed last year that all major servicers have implemented to provide efficient loan modification decisions to subprime ARM borrowers facing interest rate resets. Let me emphasize here very clearly, servicers do have the legal authority, right, and responsibility to modify loans in appropriate circumstances, even if those loans are in mortgage-backed securities pools. But in light of the recent deterioration in the broader economy and housing market, ASF has been working aggressively to develop an expanded framework that will give its servicers even more latitude to modify loans in a streamlined manner. Modifications generally, and this framework, must also be in line with the contractual rights and commercial expectations of institutional investors, such as pension funds and mutual funds, who depend on investments in mortgage-backed securities to help workers and families achieve their savings and retirement goals. As part of this effort, we are actively reviewing criteria that other loan modification approaches that have recently been announced, such as the plan implemented by the FDIC on the IndyMac portfolio and the Federal Housing Finance Agency protocol announced yesterday. Ultimately, though, we must recognize the seismic economic challenges in the United States, the epicenter of which is in the housing market, are too great for purely private sector loan modification solutions. As such, evolving servicer loan modification activities, though playing an important part of the solution, have limits to their effectiveness in addressing the extraordinary challenges in the housing market and should not be seen as a panacea for housing market ills. As such, we believe expanded voluntary government programs would be very effective in helping bridge the gap to address the potential foreclosures that commercial and contractual arrangements cannot prevent. We applaud you, Mr. Chairman, and the hardworking members of this committee for being a driving force in developing and enacting the voluntary Hope for Homeowners program last summer. program has a number of innovative elements to help homeowners refinance into a new FHA loan, and it does provide incentives for servicers and loan holders to allow those homeowners to refinance. Unfortunately, the program has met with limited market reaction, as only 42 loans have been put through the program in its first month of operation. We believe there are a number of impediments to HUD's implementation of this program, including the limitations on borrowers' total debt outstanding and the significant equity write-down that loan holders are asked to take. We believe a number of modifications to the program could allow many more borrowers access to the program and ultimately prevent their foreclosure. In addition to refinancing opportunities, the newly enacted TARP, or Troubled Asset Relief Program, allows the federal government to use guarantees to incentivize additional loan modifications for distressed borrowers. We believe there have been some positive proposals put forth, for example, by the chairman of the FDIC and that which you outlined at the outset, Chairman Frank, that would allow the federal government, through TARP, to provide credit guarantees for redefaults on modified loans that we believe would substantially increase the number of loan modifications granted and ultimately foreclosures avoided. Finally, as we believe there is significant opportunity also for TARP to purchase individual distressed loans out of mortgage-backed security trust, which could give the Treasury Department unlimited discretion to modify loans in whatever way the government feels fit. The ASF has recently undertaken a review of the various opportunities and obstacles for servicers to sell individual distressed loans out at a discount to the Treasury Department. We expect to report out some initial progress on this initiative at the end of this week. Let me just note one of the things that was opened in the opening statements by a ranking member is that securitization to some has become a dirty word. But let me emphasize and provide a quote from the finance ministers of the largest economies in the world that articulated last month that one of their top 5 global priorities is to, quote, take action where appropriate to restart the secondary markets for mortgages and other securitized assets. Simply without securitization, the credit markets in America have dried up and people don't have an ability to purchase new homes, to purchase autos, or to use their credit cards. I thank you for the opportunity to testify on this important and timely issue today. ASF look forward to continue to working with this committee and the new administration in our collective pursuit of avoiding preventable foreclosures.
Thank you. I'm going to have to, when this hearing is over, ask the maintenance people to come up with some large brooms because we are awash in straw up here from the number of straw men that have been constructed and then demolished by my Republican colleagues. Let me start with securitization. I don't know anybody who's trying to abolish securitization. I don't know anybody who's trying to substantially limit it. What I've said in every speech I've given on the subject is that securitization to me reminds me of the formation of large enterprises called trusts in the late 19th century, and then of the broadening of the stock market, an innovation that produces a great deal of good for society, but because it's an innovation, is not always accompanied at the outset by appropriate regulations. And regulation helps enhance the innovation. And in fact, one of the problems we have now is that some people who bought things that they shouldn't have bought now won't buy things they should buy. That's an obstacle to the securitization market. And just as the establishment of the Securities and Exchange Commission, over the objection of the conservatives of the day, helped the stock market flourish, the right rules here will encourage people to get into it. The next one is retroactivity. No one has even proposed, well, I take it back, a couple of people have proposed it. We haven't come close to enacting anything retroactive. We are talking, as Mr. Deutsch correctly said, about voluntary inducements. So this retroactivity scarecrow, I guess I just switched metaphors, is just a chimera. Nor are we talking, when the gentleman from Georgia said, well, but talking about decisions being made, you don't want the government to own the house. No, we don't. Nobody's proposed it. That's why we didn't propose it, because no one wants it. We are saying this. We have heard from a number of people that, and he says correctly, it isn't always clear what's the best answer. There does appear to be a consensus that in many, many cases, and again, somebody said, well, you can't protect everybody against foreclosure. True. And again, I don't know of a single human being who has said anything other than we are trying to diminish the number of foreclosures. There are people who are not going to be able to make their payments, and nobody's trying to stop it. What we are talking about is in those situations where we are told there is agreement that foreclosure would be a worse case than some modification, we have been told that there are problems in getting there. So what we talk about is not the government making the decision, but yes, I do think it's important. It's been an important matter of public policy to have somebody make the decision. The gentleman from Georgia said, well, they can go to court. my conservative friend's preference for litigation ebbs and flows. I think leaving something to the courts without adequate statutory guidance is not an appropriate thing for us to do. Now, let me just ask, and Mr. Deutsch, please submit to us specifically those modifications on Hope for Homeless. But here's the nub of it to me. On page 5, in your written statement, you say, although there's variation among individual transactions, most securitizations provide services with significant flexibility to engage in loan modification and other loss mitigation techniques subject to contractual obligations that the particular loss mitigation alternative selected maximizes the net present value or recovery. And that's clearly the case. We are told that in principle, but we are also told by many people that they can't get this worked out, that the servicer, in fact, is deterred from doing it. We tried to pass legislation to deal with that. We passed legislation, bipartisan, gentleman from Delaware, gentleman from Pennsylvania. Certainly it is the case statistically, I am told, and we saw this again with Fannie and Freddie, that entities as holders have been able to do more modification than mortgages where there is a servicer. So if this is the case, I guess to some extent, and I want to believe what you say, and I acknowledge that that may be what's in the contract, but there may still be this fear. I mean, you tell me that the securitizers, the servicers have the power to do this, but we get every indication anecdotally and statistically that it is not being done as much. So, you know, I guess I'm in the position of posing the question that Groucho posed to Chico. Who am I going to believe, you or my own eyes? I mean, I want this to be the case, but is that, are you aware that there is this disparity in the actual number of modifications, that we get more when there are owners, the holders and servicers? And if that's the case, are there further things we can do? Or what would account for what seems to me a gap between what I believe is an accurate statement by you of the legal situation and the actual experience?
Well, hopefully my name won't be referred to as Chico hereafter, but I think service...
Side point, by the way, it was Chico, because
Chico,
it was based on his predilection for female companionship. But go ahead.
You're going to make me blush, Chairman. I would, servicers have indicated that they believe and are very concerned that if they do over modifications of mortgage loans, that they would be subject to lawsuit. Those same servicers should also be scared that if they are subject to lawsuit for under modification as well.
Is there anything we can do to alleviate the first fear, other than what we've already done? I mean, I do know there's like the question of indemnification. You get into taxpayer dollars there. Is there anything we can do short of a 100% indemnification to alleviate the first fear?
I think the best thing that we can do is what the ASF is actively working on right now, and that is bringing together all of the institutional investors, the pension funds, the mutual funds, the hedge funds, the banks, the financial guarantors, the insurance companies, all those that own mortgage-backed securities, and creating a more streamlined solution that ultimately gives a standard market practice for servicers to be able to modify in accordance with that. There's significant precedence for that. The ASF created last December a streamlined framework that allows servicers, even before a borrower...
My time's up. I'm glad to hear that. And if it helps you, tell them that to the extent they are worried that we will intrude too much legislatively on this method that they believe is now working well, they can make us go away. But they can only make us go away if this effort you're talking about is successful and leads to significant modifications. The gentleman from Texas is next is on the list I was given.
Thank you, Mr. Chairman. Mr. Deutsch, what would you say the status of the secondary or the securitization market for mortgages today? You said non-existent. Is it totally non-existent, or is there some activity going on?
Well, I can provide you stats that were in my written testimony. Is that in October of 2008, there was approximately $500 billion of securitized product that was put out into the market. Sounds like a big number for those of us, but last year at the same time, it was approximately $50 billion in October of 2007. Previous cycles, it was much, much higher than that. There is absolutely zero activity right now in the securitization credit markets, which ultimately leads banks not to have the available credit to lend to consumers.
Now, Mr. Gross, you indicated, though, that y'all had made a substantial number of mortgage loans in the last quarter. Was that those numbers?
That is correct, sir.
Yeah.
And
What did you do with those mortgages?
they are either portfolio product, or these would have been product that would have been delivered through the GSEs.
To Fannie or Freddie?
I believe that the market that Mr. Deutsch was referencing was the private securitization market.
And so, Mr. Deutsch, the $500 million would be a delivery outside Fannie or Freddie. This would have been in the private market.
Correct.
sector.
And that encompasses consumer asset securitization as well, credit cards, auto loans, student loans, et cetera.
And the chairman talks about the servicers and the portfolio managers, the trustees, and all of the people that are involved in the securitization family there. What moving forward? In other words, we have some of these old contracts that are in place. What is the industry doing as we are moving forward to look at where some things in those documents could have been made better and bring some uniformity? Has anything taken place, or is the meeting that you're proposing where that should take place?
We've had a separate effort from beyond the existing, how to address existing contractual arrangements and existing modification policy, a separate effort throughout all of 2008 called ASF Project Restart, where we're examining all areas of securitization in ways to enhance the process of securitization. I would point you to a request for comment that we put out this summer that we'll shortly be updating, where we'd note a number of different ways that we're trying to create much more strengthened securitization process, which ultimately will create market discipline. One of the gentleman's comments over here was, can we create servicing provisions that will ultimately allow more discretion, more flexibility into the future for servicers who are experts at servicing to be able to do that on behalf of investors who are experts at investing? And absolutely, we believe we'll get to new standards that will even further create better securitization into the future. But we all know it's going to be some months before securitization returns. And we obviously, none of us want securitization to return in the exact same form that it occurred in previous years.
One of the issues that I have about moving down some kind of a modification road here of Congress stepping in the room again is what that does to the private mortgage insurance industry, because I think they're going to have a much stronger role, probably already have been, as people are looking to go back in to make sure that if you're making above a 75 or 80% loan, you're using, in many cases, maybe some private mortgage insurance to do that. What are the implications to those entities if we start going down a road where the potential loss could be made larger if that modification, in fact, doesn't really turn out to be inappropriate? How do we address that?
Well, I think there's two ways that we can address it. And I think it is an important comment to note that it is critical for people to have certainty of contracts moving forward. You don't want to put capital to work if you're afraid that somebody will change the rules after the fact. I do think there is a very positive way that the federal government, through TARP, can provide guarantees, and this will benefit to mortgage insurers, to the institutional investors, to financial guarantors, where this guarantee policy could apply if servicers were to take even more proactive steps on loan modifications. If those modifications would fail, that ultimately that credit risk would flow to the Troubled Asset Relief Program rather than back to the ultimate holder of those borrowers.
Mr. Gross, what do you think as in the last quarter you've originated a number of loans? Are you seeing that in any particular part of the country, or is the activity that you're reporting was pretty much nationwide?
That is a nationwide number, sir.
Okay. Well, I would say in what the chairman said is I think it would be in the best interest of the industry if you could sit down and work this out among yourselves without asking or any encouragement from this committee to do that. I think a better solution comes from the industry working out. One, you know more about the transaction than anybody in this room. And secondly, I think it would be more of a market-based, market-driven solution that would accomplish the ultimate goal, and that's to get these markets back functioning again.
I'm going to ask unanimous consent at this point to put into the record a very good report by Credit Suisse dated October 1, subprime loan modifications update. And with the indulgence, I think I want to read just a couple of their conclusions because it's relevant to what we're talking about. First, it says that loan modification is a growing but perhaps underutilized tool to reduce losses and prevent foreclosures, that redefault rates for some types of modifications are better than expected. Not surprisingly, principal reductions or interest rate reductions work better than simply sort of putting off the day of reckoning. But here's a very important point that's relevant maybe to what Ms. Deutsch probably gives some support here to what you're talking about. We show that there is a dramatic difference between how intensively servicers are using mods. Some servicers have already modified more than 10% of all outstanding 2005 and later vintage loans. Others have modified less than 5%. And then it says servicers who find the sweet spot between too many and too few will improve bond values. So the fact that there is this variation does argue for the point that there is the authority. And again, I think the success of that operation you're talking about will have a major impact on this committee's legislative agenda. And without objection, I will put this report and I recommend it to people. And it does say they are increasing, actually. Subprime loan modifications have increased significantly since we published our first report on this topic. No one program has done what we like. There are a whole bunch of them, including some individual things. So I do recommend this report to people. And the gentleman from Pennsylvania is recognized for 5 minutes.
Thank you, Mr. Chairman.
You saw that. Yeah,
Mr. Deutsch, maybe you could straighten this out. Do you see over the horizon any certainty that deflation in the real estate market is going to stop and come to an end?
The deflation in the real estate market?
The evaluation of real estate.
My personal view is that we'll continue to see price declines throughout 2009, particularly in the most troubled markets, California, Nevada, Arizona, Michigan, Ohio, Florida.
Well, if that's the case, how will rewriting mortgages and making modifications really change that reality? At some point, every week or every month, more mortgages will be going underwater, just not because they're speculative, not because they were improperly made, but just with the real estate evaluation. Does that look like it will be a perpetual problem now for the next year, year and a half? And then I wonder of what value mortgage modification is.
Well, as I indicated in my testimony, I do think loan modifications for the targeted and appropriate borrowers will be very helpful in helping stem the tide of delinquencies and defaults. But as I also indicated, given that dramatic decline and a lot of that being nationwide in home prices, is that you also need to see additional efforts by the federal government to be able to help stabilize that housing market, because ultimately declining home values do have an indication and cause of increasing foreclosures, delinquencies, and defaults. Part of that is because credit is simply not available today for either new mortgage borrowers to be able to get into homes for the first time, and also for existing borrowers to be able to refinance into different loans.
Well, I notice there's a tremendous difference in the law as it applies to real estate and mortgages. Say California and Pennsylvania. California, you just hand in the keys and you're out from under the obligation. Pennsylvania, there's actually no way that you can escape the obligation that you made on the mortgage. So it would seem to me less likely for Pennsylvanians to be able to escape relative to Californians. Now, the problem with that is whatever we do at the federal level at the present disjointure of the real estate laws across the country, we advantage or disadvantage one state over another. Would you think it may be wise at this point to adopt, at least for temporary purposes, a uniform national standard of handling mortgage foreclosures and mortgage rights?
I'm sorry, of a national standard for foreclosure
Establish a
rights.
national standard so California and Pennsylvania are the same.
Well, if we're talking about the ability for borrowers to walk away from their financial obligations, whether you view that as an investment in a home or you know, a mortgage of sorts, I do think it would be very important to be able to provide incentives for those borrowers to stay in their homes or to reduce their ability to leave those homes and walk away from those obligations.
Well, wouldn't applying the laws of Pennsylvania to the state of California decrease the likelihood that Californians would walk when they're underwater?
Absolutely. From the way you've characterized it, I think that would further disincent people from walking away from their homes.
Should we think of doing that?
I think it would be very helpful to prevent those walkaway borrowers. If you have additional walkaway borrowers, more foreclosures on the market, that would certainly increase the number of homes available on the market, which ultimately drives home prices down.
Very good. Thank you, Mr. Chairman.
The gentlewoman from Illinois, in the absence of the gentleman from Ohio, is recognized for 5 minutes.
Thank you, Mr. Chairman. There seems to be a sense of urgency and seriousness of the mortgage crisis to have creative thinking to anticipate to address the anticipated foreclosures. Is there a danger that by responding to this crisis that regulators and Congress may damage investor confidence, leading to longer-term problems?
I would say, one, investor confidence is already damaged. There are significant concerns in the investor community about different proposals that are more mandatory in nature rather than voluntary, that has created significant volatility in the market and has ultimately depressed mortgage-backed security prices. By depressing those prices, you continue to prolong the inability for issuers to put new mortgage-backed securities out into the market, which ultimately takes their ability from being able to originate the same volumes in the past.
Do you think that there was also a lack of investor scrutiny when it came to the mortgage-backed securities? Does that
Absolutely. Absolutely. There were investors who did not do the full amount of due diligence that they should have done before purchasing a mortgage-backed security. I think there are a lot of investors that have learned their lesson. Some of those are no longer investing. They're selling shoes or doing something else because of their poor performance. I think what you're seeing now in the market is a lot of reevaluation, and a lot of this is occurring through the ASS Project Restart, about how to create more market discipline for those investors and ultimately provide them the information and certainty of the products that they would be purchasing.
So we might need some financial literacy for the investors as well as the borrowers?
I think it's not just financial literacy. We also have to keep in mind in 2005 and 2006 we had enormous liquidity available in the market. There was capital flowing in from all parts of the globe into purchasing different assets, and mortgage-backed securities had very strong performance up until 2006. And so you had a lot of investors putting money into securities where they were very hopeful about very positive returns.
Could you talk a little bit about your project Restart? Will that build investor confidence?
Yeah, there's multiple prongs to Project Restart. The first and priority prong is providing additional information to investors so that they understand all the different characteristics of an underlying mortgage loans within a security. So if you're buying a conforming set of loans, say from Fannie or Freddie, they're all very fungible, if you will. If you're buying non-conforming loans, those from Alt-A, subprime, or others, there's all kinds of differentiation or variation. We're trying to be able to effectively put the institutional investors as close to that closing table for all those mortgages as possible. Obviously, given thousands of mortgage loans in a particular pool, we have to do that through data-driven exercises, and that is extremely costly, but ultimately is going to be necessary to increase the investor confidence in securitization going forward.
Okay, thank you. Then this is a general question that the centerpiece of the Hope for Homeowners program is a write-down of mortgage principal. Are servicers and investors not able to do this without the government intervention?
Absolutely not. Servicers have historically and continue to write down principal in appropriate circumstances. What I've indicated in my testimony is that the current requirement to write down to an 87% loan-to-value ratio, effectively providing 13% equity into the home, is in many cases simply too far of a write-down where servicers and or investors don't find that to be an appropriate use. If that loan-to-value ratio were increased, it would provide substantially more refinances into the Hope for Homeowners program.
Okay. Thank you. Anybody else like to comment on that? Mr. Gross?
Yes, just amplifying on what Mr. Deutsch just said. With regard to Hope for Homeowners, servicers are contractually obligated to choose the home retention or loss mitigation option which provides the best return to the investor. That is a contractual obligation. To the extent that we can do an interest rate reduction or term extension, which will provide the homeowner with that affordable and sustainable payment without doing the principal reduction, we're obligated to choose that option. So, and in most cases, when we are looking at the hierarchy of options here, the Hope for Homeowners with the effectively 13% write-down, if at least that amount, would provide for a much greater immediate loss to the investor than the interest rate reduction or term extension would allow.
Thank you. Yield back.
The gentleman would yield. I would note, and the distinction that Credit Suisse drew was a different one, and that was between either principal modification or loan reduction and the extension, because what they reported was that there was a significantly higher redefault rate with regard to simply an extension of the term as opposed to either an interest or principal write-down. So, that, as I said, they drew the line, and their argument about the simply extension was, in their experience, there's a higher redefault rate. The gentleman from New York.
Thank you. I'd like to follow up on my colleague's questioning, Ms. Biggert, on the mortgage-backed securities, where she pointed out that we need more due diligence on these products. I'd like to ask the panelists how much of the financial crisis is caused by the fact that the mortgage-backed securities were given to people who couldn't afford them under terms that were very unfavorable, teaser rates of 3% that after 3 years jumped to 9%, that they were no loans, no documents were needed. Actually, the word in New York was that it was easier to buy a house than to rent an apartment because they didn't ask about your income, they didn't ask anything, they just gave you a mortgage you couldn't afford. So how much of the problem we're confronting now was really mismanagement, abuse, and horrible behavior, and an economy that has slowed down? How much of the problem that we're confronting in the housing crisis that Chairman Bernanke and others say are the prime goal? We have to stabilize the housing before we can move forward with our economy. So we have to understand how this happened. How much of it was caused because of mortgage-backed securities that people couldn't afford and were sold to them knowingly that they couldn't afford them, and how much of it is an economic downturn in our economy? Anyone or everyone? I'd like to hear your comments on it.
Guess I'm being volunteered to go first. I would say borrowers, lenders, and institutional investors all had irrational exuberance about the direction of home prices into 2004, 2005, and 2006. Based on the significant uptick in home prices in that period, I believe everybody became very excited about the equity that was available through that.
If I could add, then, because you were talking about the prices going up, so they were very excited about it. So they didn't care if they sold a house to someone at a 3% interest rate, because they knew when they took the house back from them after having collected all that money that they could then resell the house. Now the problem is we can no longer resell the house because of the financial problems, and the houses have fallen in price. So that, I think, is an important point. So continue.
Yeah, I think no, as we've been discussing all this morning, no lender wants to take a home back in an appreciating or depreciating home price market because the cost of foreclosure are extremely high. The expectation of many borrowers and many lenders was that home prices, by continuing to increase, is that those borrowers would be able to either refinance or be able to use the equity that was growing in that appreciation.
And it's clear they cannot. So to my question, do you think this financial housing crisis is caused by the faulty, deceptive mortgage-backed securities or a general downturn in our economy?
I believe there's a combination of both a downturn in the economy, job loss, et cetera, as well as the epicenter of which, of course, is being in the housing market, where you did have a lot of irrational exuberance on the direction of home prices.
How much of the problem do you think was caused because no one was held responsible? You could sell a house, get your fee, and immediately securitize it and move to Florida. Unlike the old times when a bank gave you a loan, they held that loan and they were responsible. I used to work for a bank. I had a loan line of $10,000, and let me make sure, I was absolutely positive I never gave a loan to anyone who couldn't pay back that $10,000, or I would have lost my job. But now you just securitize it, you sell it to the next one, the next one, the next one, and no one's responsible. So should we build some responsibility back into this, some accountability? And if so, how would you suggest we do that? And I might ask, if I could add to that question, how could we, I want to sincerely applaud everyone who's moved forward with the Fannie Mae and Freddie Mac, but they say that's only 2% of the defaulted loans. Most 20% are the adjustable rate subprime loans. So that's where the real problem is. And we're relying on voluntary actions, and by all accounts, the problems is millions, not hundreds of thousands. So how can we encourage industry? Not that we are not very appreciative of your efforts that you've taken so far, but how can we encourage you to adopt as a standard the systemic loan modification protocol that was used by the FDIC in the IndyMac takeover that was so successful?
Please, we'll get an answer. Anyone want to answer?
Well, I think I would like to say that a couple things. Number one, I think everyone is in agreement that there were loan programs available in prior years which in hindsight should not have been available. And I'm happy to say that Bank of America did not engage in those loan programs at that time. And with regard to the voluntary loan programs that are there today, Bank of America thus far has closed approximately 225,000 home retention workouts thus far this year.
Thank you.
So the voluntary aspects of this for the major servicers engaged in the Hope Now Alliance and other initiatives are working. Are they working fast enough? No. We need to do more. The announcement yesterday with the GSEs, with Fannie Mae and Freddie Mac, will go a very long way in assisting in this, because this was, quite frankly, one of the areas where all servicers struggled.
The gentleman from Georgia.
Thank you, Mr. Chairman. I want to thank all the members of the panel for their testimony. I'm impressed with all that is being done, and I know it's not fast enough for anybody, but I think it's imperative that we appreciate all that is being done. It's been said that the goal that has been put on the table is that we diminish the number of foreclosures, and we all agree on that. I'm heartened, Mr. Chairman, because I believe that we may be closer than folks might think. A commitment to a voluntary program and no retroactivity is a positive place to start. So I'm hopeful that as we move forward, we will in fact be able to realize that significant decrease in the number of foreclosures. The falling home values has been mentioned as being at the core of our current challenges, and I would agree. I think that nobody would discount that at all. There's some solutions that have been offered by others out there that haven't been discussed this morning. I wondered if Mr. Gross and Ms. Sheehan, if you might comment on solutions that have put on the table, like mortgage rate buy-down and expanded home buyer tax credit. Would you care to comment on whether or not you believe that those items can appropriately address the problem or would be part of the solution?
I think we all recognize that there need to be a variety of different types of initiatives in order to be able to sort of promote homeownership in the future. Some of it is looking at how we do our underwriting and lending. Some of it is incentives. I know there was an incentive that was put into the stimulus package that was adopted over the course of the summer. And I think what, frankly, part of the issue we have right now is sort of the balance in terms of credit underwriting. You know, we've been criticized for going, becoming too liberal. I think now we have the issue where everybody's come back in the other direction. And so in order for first-time home buyers to really take advantage of these programs, whether it's a tax credit or a state housing finance agency program, we need to think about how sort of the tightened credit impacts that transaction. And so one of the things that we see a lot of potential for, and a number of the major lenders have been working and talking to the state housing finance agencies, using their funds that they've gotten through the stimulus package to put together programs for first-time home buyers that would be able to sort of bridge that gap between what's available realistically by way of down payment, because that's one of the issues that we see. So, you know, the market that exists today has moved towards a larger down payment. First-time home buyers generally don't have that available.
Would a tax credit help that?
Pardon?
Would a tax credit for initial home buyer help
a
that?
tax credit can help it to the extent that it's refundable, right, and it becomes sort of part of the, part of the underwriting of the package. But I do think that having, the participation of the states with their ability to put some guarantees around, if not all, a portion of the loan is really going to help. I mean, because what we've seen happen, certainly in the last 6 months at Chase, is that there's been a lot more activity in the FHA programs, both basic FHA and FHA Secure. We're building a pipeline for FHA homeowner. So the market is still looking to get that sort of government or, backing, if you will, until we bring the private market back.
Mr. Gross, a comment on the tax credit? No comment. Getting a little too liberal has become a disease around here, Ms. Sheehan, so I appreciate your comment regarding that. But many of my constituents believe that the capital flowing into the market has stopped significantly, as has been mentioned by you, Mr. Deutsch, and that until there's some sense of certainty about the federal government stopping its action, that the capital that's sitting on the sidelines is going to stay on the sidelines. Is that an accurate assessment of what's going on?
I think it's very accurate that many investors, until they see how situation plays out, and part of that is the home price market and the housing market, but also it is the new response of a new administration, of a new Congress. If there are steps that would significantly disadvantage them, they're quite concerned about that and are effectively taking a wait-and-see approach. And so it's not just the act of doing something, it's the threat or concern of doing something that is preventing many investors to come back into the market.
Do you have any thoughts about how we shorten that timeline for that point when there's certitude in the market where money can get back in?
Part of it is the volatility in question as to how the home price depreciation market will go down, and as Representative Kanjorski was asking about, is how many borrowers will effectively walk away from their homes? How many Jose Cansecos will we have who will just simply pick up and leave?
Thank you, Mr. Chairman.
The gentleman from North Carolina.
Thank you, Mr. Chairman. One of the benefits of a hearing at this stage in the process is to try to make an assessment of what else, if anything, we need to be doing. Seems to me that there are 4 options. We can just wait on what we've already done to play itself out. We can aggressively push and jawbone for industry action based on industry's own interest and based on legislation that we've already passed. We can wait on regulators to take action based on legislation that we've already passed, or we can consider additional legislation. And obviously one of the things we need to consider is additional legislation. That's within our prerogative, and one of the things I guess is pointed to on page 9 of Mr. Gross's testimony, where he talks about changed circumstances of borrowers being a real problem when people become unemployed, can't find jobs, the economy doesn't work like it's supposed to. So I know our responsibility in the stimulus area is one, but both Mr. Allensworth, did I get your name right? Yeah, Mr. Allensworth and Mr. Gross pointed to some impediments that are still out there, and it wasn't clear to me whether you are looking for us as legislators to solve those impediments, or you're looking to the regulators to solve those impediments, or you're looking to the industry to solve those impediments. Mr. Allensworth outlined 3 problems on page 4 of his testimony. Mr. Gross outlined a series of problems on and kind of danced around the solutions to them on pages 8 and 9 of his testimony. I guess what I'm trying to figure out is the same thing I was trying to figure out from the people who came to talk to us about setting up the new regulatory framework. What is it that you are proposing that we need to do, if anything, as legislators, as this committee at this point? Or is this a function of waiting on this to play itself out, waiting on the regulators to push you and give you a framework to operate in, waiting on, as Mr. Deutsch has indicated, the industry to set some protocols and uniform standards for services? Who should be doing that, and what should our role as this committee be in it? And I'll start with Mr. Allensworth, since he's been sitting down there during the questioning without much participation. Then I want to go to Mr. Gross next, and if I don't run out of time, the other 2 witnesses also.
Thank you. I think there are, as I outlined and as Mr. Gross and others outlined, there are a number of challenges that the market faces. I think one of the first solutions is the collaboration of market participants. I think you see with the panelists up here a willingness and a desire to work constructively to solve a lot of the issues that are outlined, and I think a lot of the issues that we discussed can be addressed through collaborative efforts of the industry. That being said, there are a number of market participants who are not on the panel today, and I think the important thing is to bring everybody together, have everybody discuss. I think we have a shared interest in.
Maybe I should revise my question just since I'm running out of time, and have you tell us what you think we ought to be doing, if anything, to move this process forward and stem the tide of foreclosures and get us out of this mess.
I don't think we have, as the Hedge Fund Association, I don't think we
No,
have,
we as
right.
members of this committee.
Right. On behalf of the Hedge Fund Association,
Okay.
we don't have any specific policy recommendations that this committee or that Congress needs to undertake at this point. I think our primary recommendation is collaboration of industry participants to solve a lot of these issues.
Mr. Gross.
I would suggest that there is a dramatic need for modernization of HUD. I know that the HUD staff is working feverishly to come up with new solutions, but because of their own regulations, they were unable to participate in the announcement, or fully participate in the announcement that the GSEs came forward with yesterday. They cannot modify their loans to a 40-year term. They cannot modify loans that are less than 4 months delinquent. And this is going to require.
Is that by statute or by their own
I believe it is by
ineptitude?
My understanding is it is by statute, and again, we as an industry would look forward to working with you on HUD modernization, because it is dramatically needed.
I think I'm out of time unless anybody has some compelling answers to the question I already asked.
Thank you.
I yield back in that case.
Thank you. We'll hear from the gentleman from Alabama, Mr. Bacchus.
Thank you. This may be out of your field of expertise, the panel, but The vice chairman of the committee, Mr. Neugenbauer, is from Lubbock, Texas, where Texas Tech is. I represent Tuscaloosa, Alabama, which is the University of Alabama. They're number 1 and number 2 in all the football polls. And he has recommended that I wear this Texas Tech hat and jersey when I go home. What do you think? Do you think that would be advisable? Or do you think he's serious? This is a serious proposal on his part?
I think that the ranking member is smarter than that.
Thank you.
I think we might have a new ranking member in the next
that's
Congress.
Right. Yes. Mr. Vice Chairman, I'm smarter than that. But thank you. That was very good advice. Let's try another one. There's been a sharp rise in foreclosure. And President-elect Obama, and many of my Democratic colleagues have proposed giving bankruptcy judges the right to modify the terms of the primary mortgages. And also they have proposed a forbearance or moratorium on mortgage foreclosures. Mr. Deutsch, let me start with you, and Mr. Allensworth, since Mr. Gross, I think you gave a very good answer you couldn't improve on. So if y'all would answer that question for me.
In short, as I indicated earlier, finance ministers from around the world have indicated the flow of credit to the U.S., to other countries, is one of the top 5 priorities to address by enacting something like a foreclosure moratorium, or which would effectively change the rules after mortgages have been made, or to create a situation where bankruptcy judges could cram down the principal values of mortgages. Both of those would have an extraordinary chilling effect on institutional investors, bringing capital back into the markets, and ultimately would prolong the credit crisis that we're in.
All right. And I guess it would obviously, if that happened, and I agree with you, it would increase mortgage costs for all other borrowers.
It would either increase the cost or simply not make either refinancing or new credit available.
Thank you. Mr. Allensworth?
I would agree. I think that the challenges that Mr. Deutsch outlined are some of the things that need to be considered. Certainly we've seen that the foreclosures in the housing market and the tying up of mortgage markets has had a huge spillover effect into credit markets and to the economy generally. So we are very supportive and want to be actively engaged in addressing the foreclosure problems. But I do think we need to consider whatever solutions we undertake, what the effects will be, not just on the current foreclosure issue, but going forward and the availability of credit going forward.
But I think it is your answer that either a moratorium or allowing bankruptcy judges to change the terms of the primary mortgages would restrict credit and drive up cost?
For both of those issues, we have not focused with our members on those issues up to this point. We would need to go back to our members to see what kind of effect they think that would have on.
Would you do that? And
we will do that, and we will get back.
Let us know.
Yes.
Thank you. This question I'll ask Mr. Gross and Mr. Sheehan. One thing we keep hearing, and in your testimony, is that you're trying to contact the borrowers and they're not responding to you. You've been unable to establish contact. Is that we at least have heard that from institutions and some of the programs that have already been deployed. Is that a problem? Are you hearing from all of them?
Yep. I think I would agree with the assessment that frequently contacting a borrower who is in default is often challenging. It requires very dedicated efforts, and it's not something, and it's done 7 days a week. I would, I guess, argue a little bit with some of the statistics that have been used. In our own case, for loans that have gone through the foreclosure process, and we look back, we have had contact with over 90% of those borrowers during that specific default cycle. And we have had contact with, I believe, about 65% of those borrowers within the immediate 45 days prior to the foreclosure event. And going back to a question that you raised a moment ago with regard to foreclosure moratoriums, One of the reasons why I don't believe that a foreclosure moratorium is either appropriate or needed is that any borrower who reaches out to their lender and says, I need help, if that loan is in the foreclosure process and we believe that they, number one, want to retain ownership of the property, number two, have a reasonable source of income, or that it's reasonably foreseeable that they're going to be back to work soon, then we will work with those homeowners and we will stall the foreclosure action. We have absolutely no incentive. We have no wish to have one more foreclosure than is absolutely required.
Thank you. Could I get Ms. Sheehan to respond?
Quickly, sure.
I think our experience has been that depending on the method of contact, we get varying degrees of feedback from our borrowers. Though I do agree with Mr. Gross that by the time you get through the foreclosure process, by and large, you've had at least one or two active contacts. But one thing we definitely have learned is that the more we can interface with counselors, the more we can have people on the ground to respond to borrowers, the much better outcomes we get much earlier in the game before they get too far underwater.
And let me just make a comment. I'll wrap
quickly.
it up with, I'm concerned about in the delinquency stage, before the foreclosures. And I have noticed that when third parties are hired or counselors, sometimes it doesn't have Bank of America or JPMorgan Chase on it. That might be more effective, and I would just urge you maybe to look at that. There are studies that show if it has that bank name on there, they may not even open it or certainly wouldn't respond.
Gentleman from California.
Thank you, Mr. Chairman. I want to commend some of the lenders here for having congressional liaisons, because very often the people in most trouble who aren't opening your mail are calling our offices, and it's good for our staff to have somebody to call. I'm particularly drawn to solutions to this problem that don't involve risk or cost to the U.S. taxpayer or do not unduly imperil future investments in mortgage instruments. And so I hear Mr. Gross saying, well, we've got loans in our portfolio, we'll work reasonably with the borrower. And then I hear horror story after horror story where people can't figure out who their servicer is. When they figure out who the servicer is, the servicer says, I'd like to help you, but I might get sued. And so the question is whether Congress should act to make sure that servicers have all the legal rights to act on behalf of their various, in effect, trust beneficiaries taken as a whole. Or are we going to have this perverse game where people say, well, we'd like to help you, and it would be in the interests of the investors that we help you, but we can't help you because there's this risk of lawsuit. The way to deal with that, of course, is for Congress to pass a law empowering trustees and protecting them from lawsuits. Mr. Deutsch, do you support that clarification?
We would not support Congress making or taking legislative action that would.
And so you want to continue to be in the circumstance where you can come here and say you want to help people, and then on the ground the servicer says, oh, I'd like to, but.
No, I disagree with the characterization that servicers are saying, I'd like to help you, but I'm afraid I'm going to get sued.
You're saying that never happens?
I'm saying servicers,
you want to come to my district?
Under their contractual obligations, have a responsibility to modify those loans in the appropriate circumstances. And that if they don't modify those loans in those appropriate circumstances, they will equally find themselves at legal peril.
Okay, so we've got two legal perils and total fear of lawsuits. Why would you oppose a statute that would clarify that the world is, in fact, as you describe it to be? That is to say that servicers are free to provide workouts, et cetera.
Because in those circumstances, you will take the one effective way that investors have to control what servicers do on their behalf. Again, the investor.
So you'd have a circumstance where a mortgage might be owned by 10 different investors, and you have one investor out of the 10 who wants to oppress the homeowner, and disadvantage their fellow investors, and you want them empowered to be able to do so, and you don't want Congress to take away that power.
They don't have the power to influence the servicer by any contractual or legal means. If they would choose to sue the servicer, anybody in America is free to sue anybody. The question is, if the servicer takes reasonable loss mitigation actions, that servicer will not be held liable by.
So why would you oppose a statute that said if the servicer takes reasonable loss mitigation actions, that servicer will not be liable?
That statute
Why do you
has
oppose
already
this?
been approved already through ESA and through the Hope for Homeowners program this summer.
So so when the servicers say they can't take reasonable action because they have a realistic risk of being sued by one of the investors, they're not telling me the truth.
But I think the point is that that's already been passed by Congress twice now.
That's what I'm saying. So you're saying the law is already as I describe it, and those servicers who describe it to me as being different are not telling me the truth.
I guess I was unclear as to whether you're suggesting something additional should be passed on top of what's already been passed.
I'm suggesting that Congress do whatever is necessary so the next time I'm talking to a servicer, they're not telling me they'd like to and it would be in their interest, but they fear being sued. You're convinced that the existing statutes give the servicers the power to do that, and that the servicers who tell me they're not empowered are just hiding.
I can't speak for what servicers are telling you in those private conversations.
Would the gentleman yield for a second?
I'll yield.
The gentleman from California has been very diligent in this. If he got such a comment from a servicer, would it be helpful if he gave you those specifics you're talking about trying to bring people together? I mean, could we report, frankly, to you and see if you can
absolutely
resolve this conflict? Because it's one that he reports that almost everybody has encountered, this gap, as I said, between your statement and what happens. I thank the gentleman.
I think we would very much appreciate that. In particular, we would be happy to have those institutional investors who own that security, that servicer is choosing not to maximize the net present value by not modifying in those appropriate circumstances. Those institutional investors will certainly.
Where you have 10 investors, and any one of them can allege by a mere negligence standard that that the value of the portfolio has not been maximized, you provide the servicer with a safety through inaction, and I look forward to working with the committee to try to provide servicers with as much insulation as possible from lawsuits when they act in good faith to try to maximize the situation for both homeowners and for investors. And you can always make the allegation that a servicer has not maximized the portfolio value, and perhaps we need a higher legal standard, a gross negligence legal standard, in order to make them feel secure. I yield back.
I'm going to ask for United States for 1 minute. Just you've twice said, Mr. Deutsch, and I'm intrigued that they're also liable to be sued if they are too tough. Who's got standing? I mean, if I had a mortgage, could I sue them for not reducing it, or is it some other investor? I mean, I understand the theoretical possibility. I know who the plaintiffs are in the case of the people who think they're not getting enough money. But seriously, who would be the plaintiff in a case that said you haven't been doing enough reduction?
The institutional investors who own the mortgage-backed securities would, under the.
Have any of them? I mean, we have heard threats on the one. Maybe, Frankie, I'll tell you this. It could be very helpful if you could talk to a few of them and have them threaten to bring such lawsuits. That might help with the problem we've all encountered.
I'm not aware of any institutional investors suing any servicer either for over-modifying or for under-modifying mortgage loans right now.
And I guess I just asked you to engage in barratry, so I can't do that. I retract it.
Thank you, Mr. Chairman, and let me thank those of you who are here. I think that some of the atmosphere, and maybe you're leading it, or part of it, is going to change around here. The elections that were just concluded, change is on the way. And I think that what President-elect Obama is talking about is that we're going to have some civility, but we're going to talk and try to figure out how we can really make a difference for the American people. And I still, for one, believe in the statement that the American dream is alive, and that I think that home ownership is the integral part of that. I still believe that we'll get back to the point where, as I've always said, that it's better to own a house than rent a car, because a house is an appreciating asset. It's not today, but it has been, but I think we'll get back to that. And a car is a depreciating asset, and I think that will continue. So I still think that one has pride when they own their home. And the objective here is to keep those individuals who have lived with the dream of owning a home, as my parents did. And the key is when you are in this situation that we're currently in, and we talk about, you know, helping Wall Street, now it's critical to show that we can help Main Street and these homeowners. And so to that end, as I indicated in my opening statement, I've got together with individuals in my district, counselors, lawyers, et cetera, with people coming in. And one of the problems that I observed is when they are talking, the homeowners and their advocates, to individuals that call up banks, some of the times what they receive is individuals where the servicing have been outsourced. And the people that they're talking to, their call centers are in foreign countries, and that seems to hamper responsiveness and ultimately the ability to help the distressed homeowner. We've had one situation where the person's home was nearly ready to go on the auction block, and as a result of trying to get somebody to do something timely, there was just, you know, they couldn't navigate the system. So I was wondering whether or not you have seen the impact of outsourcing call centers to foreign countries on the responsiveness of lenders to the distressed homeowners, and is there a system where you can provide immediate foreclosure prevention and loan modification solutions on the ground with the local banks that are there, you know, maybe the branch managers that are in the districts. You know, I'm calling a meeting with them tomorrow to see if we can call them directly and put something together to help these folks that are about to lose their homes. I'll start with Mr. Gross.
Yes, Bank of America has not outsourced any call center activities to any third parties. We do have call centers in India and Costa Rica. These call centers are focused on very preliminary delinquency types of activity, but they are not handling any of the home retention, more seriously delinquent accounts. At no time are these accounts allowed to get through to the India call centers.
What about a Chase?
The answer is essentially the same. We do have a call center in the Philippines, and that handles only what we call early stage delinquency within the first 30 days. All the loss MIT specialists are at Chase.
So, I'm going to check. I personally was sitting there when we got the runaround, and some of the homeowners that I know was, and I don't know whether it was, I'm not saying that it was with Chase or with Bank of America, I'll verify, but I know that the homeowners oftentimes had been frustrated themselves when they were trying to rework some of the modifications, and that's why I got these advocates in there that's making a difference. Let me ask, was there any consideration also further, because what we're trying to do is to help provide to these homeowners some financial literacy, some counseling with reference to how to budget classes and debt management, so that if they do have the mortgages reset, then they can make sure that they keep them and understand them. I was wondering if there is any thought of the banks doing similar and or contracting or working collaboratively with community-based organizations to help provide further financial literacy and others to some of these people that are about to lose their homes.
Thank you. Bank of America has a very active and large neighborhood stabilization program that does go into home buyer and consumer financial education, as well as working with local neighborhood groups on REO properties and dispositions. So we are very actively involved in those activities you outlined.
Yes, I would just, I would say that we are in the same position in the sense that we have a lot of pre-purchase counseling that's available. We have home buyer seminars. We have a lot of work that we do with our neighborhood groups and community counselors. I would agree with one statement that you made, and it's something we've been actually looking at, which is, what is the best way to sort of handle the total debt picture post-modification to ensure that, once that modification is made sustainable, that we don't have additional new debt coming into the picture to sort of have the situation reoccur. And that is a budgeting issue, and I agree with that. And I think we should focus more on that.
The gentleman from Massachusetts.
Thank you, Mr. Chairman, and I want to thank the ranking member and also the panelists. I appreciate you coming here before the committee and trying to help us with our work. I have somewhat of a confession to make. I also serve on the Government Oversight Committee, which is looking backward at this crisis, looking at AIG and Bear Stearns and some other firms, Lehman, that have had problems, as well as being on this important committee with Mr. Frank and looking forward. But I have to confess to an irony. About 10 days ago, I was in a hearing room just down the corridor here, criticizing roundly some lenders who were not careful enough in their lending practices and thereby contributing greatly, I think, to our current crisis. And here I am today about to press lenders for not being aggressive enough in this modification process and in their lending practices. So I know that someone once said that consistency is the last refuge of the unimaginative, and so I guess I cannot be accused of that. We have talked about the Hope for Homeowners program, and you're all familiar with that. And we had original hopes that there might be 400,000 folks that would be helped by this program. The most recent report, and I think the chairman has submitted the Credit Suisse report, and also HUD has reported that instead of 400,000, we've helped 20,000. And what I'd like to know from you, are there characteristics within that 20,000 that we have been able to help that would be instructive to us going forward? Or are those just all whole mortgages, individually owned? Is that the profile of the person that we've been able to help? Mr. Deutsch?
I'd have to see exactly which loans are going. I haven't reviewed which loans have gone into the Hope for Homeowners program. I think what we've outlined are 3 different ways that the Hope for Homeowners program can be expanded and modified to be able to increase the number of loans that would be able to go into that. And it encompasses a number of the things discussed today about being able to acknowledge that consumers have a lot more consumer debt than I think has been previously acknowledged, that widening that debt-to-income ratio would be able to, widening that net would allow more borrowers to go in. There's also some hesitancy to servicers from getting sued by state and local governments based on consumer privacy laws that we could use some clarification on.
Mr. Gross, I don't know if you can help us on this, but there have been 20,000 people that we have been able to help. And perhaps it's the characteristics of those people that are different from the group that we haven't been able to help thus far that might be instructive for us to be more productive. Are there other people in the same category as the 20,000 that we've helped that we're not reaching out to? Is that part of our problem, Mr. Gross?
I apologize, sir. I am not familiar with the characteristics of the 20,000 borrowers that you're referencing.
All right. Ms. Sheehan, take a shot.
I would say, and I think we talked about this a little bit earlier, and I'm not either. I'm not familiar necessarily with the profile of the borrowers, but they will have certain characteristics in common, meaning that they will probably be more seriously delinquent. And the reason it's important to mention that is that plays into the debt-to-income ratios, which are a constraint on the program. And so we have found that it's easier to put people into modifications, frankly, than to put them into Hope for Homeowners, given some of the characteristics of the program that those borrowers don't fit.
Okay. Mr. Allensworth?
I'm not in a position to be able to talk about the characteristics of any of the underlying loans that are going into or not going into. I think one of the things we've heard is consistent with what Ms. Sheehan just stated, which is that alternative methods of modification have seemed to be an easier path or a more successful path to this point than hope for homeowners.
Okay. Thank you very much. I yield back, Mr. Chairman.
Gentleman from Texas.
Thank you, Mr. Chairman. Let me thank the witnesses for appearing today. And let me start with Ms. Sheehan. Ma'am, what percentage of your workouts wherein you have modifications are portfolio loans?
I don't have that exact data with me.
Would you say the majority are?
I would not be prepared to say the majority. I would actually want to get you good data, because the reality is we do modifications today, both for our own portfolio as well as for loans that are in securities where the pooling and servicing.
So the answer is you don't know at this moment. You can acquire the intelligence at a later time.
Yeah.
Mr. Gross and Ms. Sheehan, are servicers compensated for cost incurred by the servicer when a mortgage is foreclosed upon?
Servicers are reimbursed for third-party expenses that are incurred in the foreclosure process, yes.
Okay, and would you concur, Ms. Sheehan?
Yes, I do.
Okay. Must servicers make payments from the servicer's coffer to a mortgage holder pending a foreclosure?
As a general rule, yes, we must advance the scheduled principal and interest payment to the investor through the foreclosure process and generally through the disposition of the REO property.
Do you concur, Ms.
Yes.
Sheehan? Okay. Now, the question becomes, finally, given that I only have 5 minutes, what reward does a servicer receive for restructuring a loan?
Well, number one, we now have a performing loan on our books that hopefully will be sustained over a period of months or years.
No, excuse me, Mr. Gross, I have to interrupt that because time is of the essence. What reward does the servicer receive? The servicer receives?
The servicing fee that we collect on performing loans.
So you receive the same reward that you receive if the loan were not going to foreclosure, correct?
That is correct.
Okay. Now, if this is true, if the servicer receives some benefit in the sense that if a loan is going to foreclosure, the servicer benefits by getting that done as quickly as possible because you're paying money out of your coffer, you're incurring expenses that have to be reimbursed. If that can be seen as a benefit to move this to foreclosure and you don't receive a reward for restructuring, it seems to me that we have a circumstance wherein servicers will say, yes, I really do want to restructure these loans for various and sundry reasons. But the actual fact and the truth is that servicers have a somewhat of a burden in the process. They've got to pay, they've got their costs that they're incurring, and then they have these out-of-coffer fees that they have to pay pending foreclosure. Question is this: given that the yield spread premium, now this is a stretch and you're going to have to really follow me here, given that the yield spread premium helped us to get into this problem, which means that the originator got a fee for causing a person to take out a loan for a percentage higher than the person actually qualified for. And I'm sorry if the people at home don't follow this, but you and I know what I'm talking about. Why not reward the servicers for restructuring the loans? A reward above and beyond what the servicer will ordinarily get if the loan continues to be paid. Why not simply reward the servicer?
In many cases, there is an incentive.
I believe the many cases theory, but we're talking about now a wholesale problem that I keep hearing retail solutions to. Let's talk about a wholesale solution. Why not on a wholesale basis reward servicers, make it known, publish it, that they are rewarded, just as we do with real yield spread premium, they are rewarded for a solution that involves a restructuring of the loan. This would cause them to have reason to move to the table aggressively and try to restructure the loan, meaning work with principal, work with interest. They would have reason to do this. Why not reward them for doing it?
The reward that you are referencing is not contained within the pooling and servicing agreement.
I understand it's not in the contract, and I would not abrogate contracts. I think that there are some constitutional problems whenever we start to talk about the government imposing itself into contracts. But if I may just say this, Mr. Chairman, it seems to me that the system as constructed provides no incentive other than the servicers making commentary, no incentives for the servicers to do what the servicers say they would like to do. I yield back the balance of my time.
Thank the gentleman. Just to make a point to the gentleman, I believe in the thing that was adopted yesterday with Fannie and Freddie and the government, there's a move in this direction where they pay servicers to do the modification. Isn't that right?
Yes.
Okay, I thought that was the case. Mr. Cleaver is recognized.
Thank you, Mr. Chairman. I will yield 10 seconds to my colleague.
Thank you, and I thank the chairman for the commentary. My comment went more to the institutions that are currently working with the servicers that are private institutions working with servicers as opposed to what the government might do. That was why I tried to encourage something that might be more suitable along having private enterprise work out the problem.
I'm going to have to move quickly. First of all, have we been in this mode of workouts long enough to have any kind of data on modified loan redefaults? I mean, do any of you have any information on that, please?
If you look at the Credit Suisse report that I think was passed around, there is data on the redefault rates. They run anywhere from 20 to 40 to 50%, depending on the type of loan you're looking at, the type of modification, part of the country, declining home prices. Obviously, a lot of variation depending on those factors.
So with a 50% redefault rate, is that a point of discouragement for servicers to want to spend time in trying to do a workout?
No, it is not. We will continue to work with those homeowners, and if they redefault, then we will work with them again. We are dedicated to finding ways to keep them in their homes.
Okay, that's where I want to move next anyway. We have the cost of the modification, as I understand it, rolled into the loan, albeit at the end. Am I correct?
I'm sorry, I don't know.
The cost of the modification.
There is a cost. There are no modification fees generally charged to homeowners for these, with some small exceptions.
Do all of you agree with that?
Yes, I agree with that.
Okay. Now, if a person wants to have his or her home modified, wants the loan modified, they're going to probably need an attorney.
No.
No.
So they can go straight to the servicer and get the workout.
Yes.
Yes.
Okay, but now servicers don't always have the loan documents. And how do we know that the loan if a servicer possesses the loan documents, how do we know that the documents are not fraud written? I mean, because that has been one of the problems that created the current turmoil in the financial markets.
If you're referring to fraudulent loans, those are handled outside of our normal modification processes. And
yes, but how would the servicer, I mean, how would a servicer know whether he or she is involved in trying to do a workout on a loan that is fraudulent, and considering the fact that the servicer does not always have the loan documents? Am I right?
I think generally, I believe that the servicer does have the loan documents, and I assure you that homeowners that find themselves the victims of fraudulent loans are usually pretty vocal about telling us what the fraudulent aspects are that
Yes.
they believe.
Yeah, okay. I'm sometimes inarticulate. I don't know how to ask it any other way. How do we know that, I mean, how will the servicer know whether or not that the mortgage is fraudulent or not?
Yeah, and is there a particular type of fraud that you're concerned with? I mean, there are different types of fraud in mortgage transactions. Some appraisal.
I'm asking some real live questions that I'm running into, whereby a person was able to get a mortgage, and in this case, his income was ratcheted up so that he would qualify for a loan. So he goes in to get a workout, and 30, 40 days later, he gets a knock on the door from the FBI, and now they want to talk about, he had a fraudulent loan. He had no knowledge that that his income had been increased by $25,000 on the loan documents. Are you walking with me?
I think the answer is the servicer does have access to all of the loan documentation originally, so that they can go back and look at the paperwork to say, here it was, and then look at, do the forensics on who signed it, whether it was the mortgage broker or others.
Okay. Let me ask the question another way. How does the servicer know whether or not the loan is fraudulent?
From direct communication from the homeowner.
Okay. I need somebody smarter to ask the question, because I know you're smart enough to answer it. But I have a real life situation where somebody ended up trying to get a workout, and they find out without their knowledge, the loan documents and everything that has transpired in the mortgage is fraudulent. And he's working out an agreement with the servicer, trying to get. Well, now he has a new problem that the FBI is involved in, and the loan servicer didn't recognize it. They ended up I guess the subprime lender was under investigation, and it maybe in another lifetime he can get his house back or something. Thank you, Mr. Chairman.
The gentleman from Indiana.
Thank you, Mr. Chairman. Is there, when you're putting your foreclosure information together, to B of A or to Chase, do you have like a formula that you use when you look at these documents and you say, can't make it, we're not going to be able to help, can make it, let's put a program together on this one?
Generally, yes, there are formulas and underwriting criteria that are used. As we've seen in recent months and weeks, days in the case of the GSEs, many of those criteria and standards are being greatly simplified from what they have been in the past. And this is usually predicated upon information that we receive from the homeowner as to their present financial circumstances, so that we can create this affordable and sustainable payment for them.
Ms. Sheehan?
Yes, it's the process that we go through in our, working with the homeowner is to get information from them on a stated basis in terms of their income. We do have a housing ratio. We set up targets in terms of how much of their gross monthly income ought to be toward their housing expense payment. And so the ratio moves based on income. So it's lower for lower incomes.
And is that information available? For instance, if we have a family sitting at home wondering, we don't know if we can make this or not, and if it's even worth trying. I wonder if Chase will work with me, or B of A, or Citi will work with me. And before they make the call, is there any way that they can know, here's the standards by which you judge?
The standard that we have published and is in our recently announced program says that the first year's principal and interest should roughly equate to principal, interest, taxes, and insurance, should roughly equate to 34% of the obligated borrower's gross monthly income.
And when that decision is made by your organization, where along the chain does that call get made when they look at this, family's particular situation? Who makes that call for you as to whether you're going to try to work this out or whether it's beyond hope?
Generally, we, the servicer, would make that call.
That would be the parties who are charged, the counselors who are charged with working with the borrowers on the loan workout. So, in other words, they would gather the income information, they would verify the income information, they would test it against the housing ratio to see if it was sustainable, and then they would work with the homeowner.
But I guess what I'm saying is when the homeowner makes that first call and says, can we put this together? Is it like the second or the third or the fourth person that they talk to? Is there a particular division charged with that?
I think we would all try to make that decision and communicate the answer to the homeowner as early in the process as possible, hopefully with the first person that they talk to, but it may require follow-up conversations.
And I know we're trying to make this as simple as possible. For the homeowner who looks at this, many of them will say, I don't know if I can handle putting this together and getting the best possible situation. And they will get legal counsel or other. Can one of the homeowners working with you receive the same kind of deal, the same kind of workout that they could with legal representation or other?
Yes.
Absolutely.
Okay.
And in fact, we encourage them to work with our community credit counselors to make sure that they're comfortable in dealing with the servicer to get the best workout.
And thank you very much. And Mr. Deutsch, when you mentioned that 87%, that range doesn't really get it done for the investors. And I was reading in your documentation, you talk about 97%. And at that point, it may not get it done for the other side. Is there a happy median in this, where you look at combining a different number along with maybe changing the terms a little bit? What are the other variables at play that can make this work?
I think there's multiple variables. And by other side, do you mean the government or by the borrower?
Yep, probably both.
Because there is, a happy medium there of having some equity in the home for the borrower, some, desire to stay beyond it just being their home, which should be, sufficient on its face. But having some equity there is quite helpful. I think 87%, as we've indicated, I think there's 42 loans that have been put into the program so far. And we're not talking just securitized loans here. It's securitized as well as portfolio-held loans, GSA loans, et cetera, that have been put into the program. I think servicers have been reticent to put anything in there because of that significant write-down. So that number, maybe it's not 97. There's a range of different numbers there, but clearly what we're seeing so far is the 87 is simply is too low.
Thank you, Mr. Chairman.
Gentleman from Illinois.
Thank you, Mr. Chairman. The first question, I guess both Mr. Deutsch and Mr. Gross have mentioned the possible benefits of having standardization in the mortgage modification language in these things. And do you have at this point agreed upon, well understood language that could be included in all future securitization contracts that would make them easier to unwind in future situations like this?
I'll take the first shot. We are working on that right now. Given our expectations that securitization MBS volume won't really revive or restart in the next couple months or few months. We're focusing our efforts more on the loan modifications, effectively getting through the night before we start working through into the dawn.
Bank of America is a very active participant in working with the ASF and other industry parties to construct that language.
Okay. And one of the issues in some of the written testimony had to do with the different risk tranches and the conflicts of interest between the riskier and the less riskier tranches, and they may have different points of view on mortgage modification and how early and aggressively you should pursue it. And I was wondering if there were institutions that basically, particularly, just institutions in general that specialized in the highest or lowest tranches of these that might have very different points of view and might make it difficult to get an industry-wide consensus on this. I guess
Well, I think that different market participants tend to go into different levels of the different tranches of the pools. Hedge funds tend to be in the more junior classes of the tranches as a general statement. Mutual funds, pension plans, insurance companies tend to be in the more senior tranches. There are differences in terms of the risk profiles there, but I think there's a lot of common ground where all investors working together with the servicers can come to a conclusion that mortgage modifications are in the best interest of all of the investors. Obviously, I can speak on behalf of hedge funds, not on behalf of the other investors, but we do believe that effective modifications are the preferable course of action and strongly encourage that.
So you don't see it as an insurmountable object to getting an industry-wide consensus?
Not an insurmountable object, no. It requires discussion.
Okay, and my last question is, there's been a lot of attention recently towards the concept of what's called dynamic provisioning, which in the case of banks would automatically adjust the bank capitalization requirements according to market conditions. And my question is there something analogous that could or should be applied to the mortgage and securitization industries to automatically adjust the origination and securitization standards according to market conditions, to not have simply static requirements, but make them have an eye towards whether we're in an asset bubble or so on? Anyone wants to field it can.
I'm sorry, that's outside my area of expertise.
All right. Fair enough. Then I yield back.
The gentleman from California.
Thank you, Mr. Chairman, and thank you to our witnesses this afternoon. I would like to say that while the word securitization is not a dirty word, I don't think it's a clean word. And if you were the recipient of as many letters as I have received from constituents over the last 2 months, many of which I'm signing here this afternoon, they are hopping mad about what has happened because they feel like they're holding the bag and a lot of people were able to walk. When you don't have any skin in the game, it's really easy to conduct yourself in a risky and irresponsible manner. And I think the securitization that went on in its heyday was very much like that. Now, one of the things that you said, Mr. Gross, that I thought was worthy of us reviewing, it appears that many of the servicers have a whole level of subjectivity in terms of making the decision as to whether or not they are pursuing their fiduciary duty in terms of making sure the investors are maximizing their return, and the determination that they must modify because they can't be unreasonable in modifying, and that we would be best served by having something that was standardized for all servicers. Did I understand you to say that?
If I understand your question correctly, I believe that would be fair, yes.
Now, if what Mr. Lockhart proposed yesterday is embraced, where the program that is being implemented now would be initiated if there were 3 missed payments where it was a home that was owned, was the primary residence, and where there had not been bankruptcy filed yet. And this program is going to be implemented in which they will be reducing the interest rates, extending the life of the loans, or deferring payments on the principal. Then it makes sense, does it not, that we just mandate that for all servicers in this country?
Well, number one, that was That program is specific to, at this point, Fannie Mae and Freddie Mac.
Correct.
Who have different servicing guidelines than what is often contained in the mortgage securitization market. And if I could give you an example, in a private security, generally speaking, I can modify a loan that is either in default or where I find that default is reasonably foreseeable or imminent, which means, in theory, I can modify a loan that is contractually current or that is delinquent only one payment. Yet the GSEs have dramatically different guidelines than that, and as you just read, where it is owing 3 or more payments, so it is much later in the default cycle that we are allowed to give these modifications than what we could in the private securitizations.
Okay, but we could, in fact, I guess what I'm getting at is I want some servicer principles that are going to be used throughout the marketplace so that consumers and homeowners in this country can feel confident in talking to their servicer and say, well, wait a minute, there's a law now that says if I've missed up to 3 payments and I live in my home and I haven't filed bankruptcy, that you need to talk to me and we need to try and work this out. And I think if we sent that kind of a message out, you're going to have, defaulting homeowners more willing to come forward and to negotiate, because I don't necessarily think they know that they are in a position to negotiate.
Okay, I believe that the American populace, the homeowners, are aware of the fact that they have the right to call their servicer and that the servicers are ready, willing, and able. We are ready to talk to them and to try to reach solutions to this. I also believe that there is a legal obligation that is already there on the for the servicer to undertake the actions that you're already referencing.
All right. One last question to all of you. I read recently where homeowners that have been absolutely current, they have a prime mortgage, are now looking at their scenario and thinking, am I a fool to not walk away from this loan because the house is now worth less than the loan that I have? What do we say to those individuals who've been playing by the rules but now are looking around them and saying, wait a minute, I'm a fool to be doing this?
For owner-occupants, I do not believe that the lack of equity or declining property values is a primary reason for default. These homeowners that are defaulting, that are owner-occupied, are defaulting because of employment issues, underemployment issues, medical issues, divorces, life events that are occurring that have made these loans unaffordable. For the properties that are being walked away from, it is my belief that those are largely non-owner occupied properties where someone bought them as an investment and they've simply said, I'm not going to put any more good money into this deal.
I would agree with Mr. Gross. I think that has been our experience also at Chase. I mean, people who live in their homes or in communities, their children are in schools, they don't just walk. It's usually because there's some other economic event that has happened to them.
My time's expired. Thank you, Mr. Chairman.
Thank you, and I'm glad you elicited that answer. I ask unanimous consent that one of our most distinguished, and I hope temporary, alumni, the gentleman from Georgia, be allowed to participate. Without objection, I recognize the gentleman for 5 minutes.
Thank you, Mr. Chairman. How many people do you run into who you simply can't work things out with because they've got other debt problems that can't get resolved?
That is a very real issue, and I think one of the, as you've noticed in most of the recent announcements from whether it be FDIC and IndyMac program that we've announced, they generally deal with the payment for the first mortgage, principal, interest, taxes, and insurance.
Mm-hmm.
And we're now hearing some people saying, well, that doesn't take into consideration the homeowner's other obligations, auto loan payments, credit cards. And our belief is that it is unfair and not contractually viable for us to say that we are going to reduce interest rates or principal on first mortgage debt in order to subsidize other homeowner obligations.
Do you ever encourage individuals to consider filing a Chapter 13 or a Chapter 7 to resolve the other debt issues as part of the process of getting them to a point where they're able to service a modified loan?
No, that would not be part of our discussions
Do you work with people who have already filed? So, for example,
yes, we do.
So an individual could choose to file a 7 or a 13, clean up their debt, and then come to you and say, hey, look, I want to keep my house. I can't keep it under the current circumstances. Will you modify?
We work with those homeowners every day.
What percentage would you say?
Percentage of...
Do you have an idea of what percentage of individuals that you're working with now to modify debt are individuals who have filed a 7 or a 13 and dealt with their other debt that way?
And this is a guess on my part, but I would say less than 2%.
Less than?
Yes, less than 2%. And I would also note that of homeowners that have filed bankruptcy, the last number I saw that somewhere 60 to 70% of those homeowners are contractually current on their mortgage obligations.
At the time that they file bankruptcy?
That's correct.
What is the overall percentage of folks that you think you're going to be able to reach? The estimate that we've had is that there are literally millions, I don't know what the current estimate is and precisely, but millions of individuals who are going to default if they haven't already defaulted, and who are going to go through a foreclosure process unless some other remedy is available to them. They're simply not going to be in a position to pay these loans. What percentage do you think you're going to be able to address using the programs that you currently have in place?
I believe that the programs that we currently have in place will handle the vast majority of homeowners. And I would stress again that we have contact with over 90% of the homeowners who do go through a foreclosure action. We will work with every homeowner who wants to retain ownership.
Do you have any statistics, the percentage of individuals that you just can't work with because they're just not able to
I don't
meet
have
their
those statistics with me. We could work with the committee afterwards.
That would be very helpful to have those statistics. The impression that I'm left with is that there are an awful lot of individuals who, because of other debt issues, are simply not going to be able to take advantage of the programs that are currently offered without some other form of help. And you've already identified a fairness issue yourself, saying why should we be modifying first mortgage obligations, and yet all these other obligations are not being modified. There's no practical mechanism outside a bankruptcy setting to deal with the multiple creditors that the typical consumer has. And simply the fact that we see an awful lot of recidivism, follow-on defaults as a result of the report that I guess Deutsche Bank has provided us. Evidences the fact that a lot of people are struggling. They really want to keep their house. They'll do the deal with you, but practically speaking, that deal is one that they're not going to be able to live up to because of their other problems. It'd be very helpful to have some statistical studies on this to see to what extent this program can actually be expected to be effective, or do we have to take some other action? The action I would suggest is not to have us step in and try and prop up borrowers, prop up lenders, et cetera, the folks who have gotten themselves into this mess. It's to force them to deal with it, perhaps by permitting modification of a certain type of mortgage for a certain period of time in a Chapter 13 setting. But if you've got evidence that that's not necessary because you are going to be able to deal with all of this, then I think that would help all of us here in Congress to get past this question whether or not we should be modifying bankruptcy law in order to address this issue. I have nothing further, Mr. Chairman.
The hearing is adjourned with our thanks, and there will be follow-up. Ms. Deutsch, in particular, we'd like to be able to stay in touch with you on this effort you have mentioned, because that could have a great impact on what we do going forward.
We'll keep you up to date.
Yes, members may have the appropriate time to extend their remarks to the record.